Okay. Good evening, everyone. Welcome to Byju's Exam Prep IAS. This is Sham Kagur here. Now, before I start the discussion, if there is no issue with the sound, can you please give a thumbs up? Done. Let's start. So, last week, I hope remember we started with the discussion on the concept of inflation. In inflation, what we have discussed so far, right? What is the definition of inflation? Inflation refers to consistent or persistent increase in the price level of basket of commodities. Now, when you say basket of commodities, it could be only goods, it could be services also. In case of WPI, we only consider goods, 697. In case of the CPI, Consumer Price Index, we consider the basket of goods plus services, right? Now, this is one definition. Apart from this, I also given you multiple definitions. For example, one more definition I told you was whenever you talk about inflation, it simply refers to a situation wherein the purchasing power of money is continuously falling. That is, with the same amount of money, how much you can purchase in the market, that will keep on declining, which means purchasing power is coming down of a currency. Then we have discussed the classification of inflation. Right? We have discussed two concepts there. One is the classification based on the rate of inflation, right? 2%, 8%, 10%, etc. Right? Where we simply say whenever it is in a single digit, we have one classification, double or triple digit, one classification. Wherever the number is very, very high, one more classification, right? So moderate, hyper, right, etc. We have discussed all of that. Then the most important classification is based on the causes. We have discussed one more classification, cost push inflation, demand pull inflation. Whenever the supply side factors will contribute to inflation, that is called as a cost push inflation. And whenever the demand side factors will contribute to inflation, that is called as a demand pull inflation. Then there is a discussion regarding the measurement of inflation. We have two measurements. One is a WPI. In the wholesale market, we will calculate the rise in the price level, that is called as a WPI. And in the retail market, that is where I purchase the goods and services. Whenever the prices will increase, that is called as a retail inflation, CPI, Consumer Price Index. Within WPI, three groups are there: manufactured articles, manufactured articles, primary articles, right, and fuel and power. Then in case of CPI, six groups are there. The highest weightage is the food and beverages around 46%. Below that, there is a miscellaneous. Below that, right, one more group is fuel and power around 7%. And apart from that, why there is a difference between WPI and CPI measurement, I've told you. And if there is a continuous inflation, wholesale, if there's a continuous wholesale inflation, then I've proved it. We have discussed this, by the way. Whenever there's a continuous wholesale inflation, right, that is a WPI, then it will have an impact on even the retail inflation. CPI will start increasing. Then we have discussed certain important concepts related to inflation, that is deflation, disinflation, right, etc., etc. Right, now we are discussing the MPFA, Monetary Policy Framework Agreement. Let me start from there. Monetary Policy Framework Agreement. Right now, what is this Monetary Policy Framework Agreement, or else flexible inflation targeting? In case of Monetary Policy Framework Agreement or flexible inflation targeting, there is an agreement which was signed between the Government of India as well as the RBI back in 2015. And why there was a reason to sign this agreement, we have discussed. The Reserve Bank of India generally is in a dilemma. What is a dilemma? If RBI reduces interest rates, growth will be promoted, but there's a danger of inflation. But on the other hand, if RBI will control inflation by increasing interest rates, then there is a danger that the growth rate will get limited, or the growth rate will be limited by this rise in the interest rate. So to basically balance between both of these objectives, Government of India, RBI signed an agreement which is very famously referred to as Monetary Policy Framework Agreement. Under this, right, under this Monetary Policy Framework Agreement, it is the duty of Reserve Bank of India to maintain inflation at 4%. I have remembered the term, right? 4%, 4%. But again, understand the logic here. You cannot always maintain exactly at 4%. certain flexibility has to be provided to you. That is a precise reason. There is a flexibility of 2%. That is, the RBI can allow the inflation rate to reach maximum 6% or fall up to 2%. But the number that is fixed is 4%. Now, what if RBI is not able to maintain the inflation rate above, or let's say, if it goes above 6% or below 2% for consecutive 3 quarters, then what will happen? In such a situation, Reserve Bank of India will have to give an written explanation to Government of India. It has to tell what are the reasons, what are the causes of such behavior of inflation. It has to explain why RBI has not been able to control this inflation, and it also has to explain what measures will be undertaken by RBI to bring it under control. And now this is what we have discussed in the last week. Let me begin. Let me begin from the next point. That is, in case of targeting inflation, we generally use the headline inflation. And I hope you remember this. Between headline inflation and the core inflation, it is the core inflation which is a better indicator. Do you remember this discussion that we had last week? Between headline and core inflation is a better indicator. And the reason is very simple. In headline inflation, we'll consider all the commodities in the basket. The problem with covering all the commodities is that the prices are very volatile. In certain months, the prices will be very high. In certain months, prices will be very, very low. For certain commodity, not all the commodities. Best example for that is the food and fuel commodities. Food and fuel commodities prices are short lived, prices are very unstable, and that is the precise reason when you calculate core inflation, we will exclude the food articles as well as the fuel articles and calculate inflation for the remaining, which is called as a core inflation. And between both of them, right, I hope remember the discussion that we had. You only answered by saying yes sir, right? In that case, core inflation is a better indicator compared to headline. But in the context of the inflation targeting, when you talk about inflation targeting, what kind of inflation indicator are we using? We are using headline CPI. We are using headline CPI, consumer price index. That is, the headline CPI is used under the concept of inflation targeting. Now, don't you think automatically the argument will come now? What is the argument? On one side, we have concluded that core inflation is a better indicator compared to headline, right? And on the other hand, we say that headline CPI is used for inflation targeting. Now the question is, if core is better than headline, why are we not using it? Why are we not targeting 4% core CPI? Why are we targeting 4% headline CPI? And this is basically the discussion regarding that. Let me start with, why should we use headline inflation? Right? Why are we using headline inflation? Why should we continue to use headline inflation? Reasons are very simple. One, in headline inflation, we have certain commodities whose prices are volatile, whose prices are unstable, agreed. But don't you think it is the food and fuel commodities whose prices will affect a common man to a greater extent? I'll repeat the statement. It is the food and fuel prices which will have an impact on the common man to a very greater extent. Now, how can you measure inflation or take an indicator of inflation where you're not considering food and fuel commodities? Because in core, we will not include them. We'll exclude food and fuel commodities. So the argument is simple. We spend day-to-day basis on food. We spend on day-to-day basis on fuel. So how can you make a policy considering an inflation indicator which doesn't include food and fuel commodities? That is the first argument. Second argument, we already have implemented this concept of inflation targeting, taking headline inflation as an indicator from 2016. We have implemented this from 2016, and for 5 years we have implemented till 2021. And I've told you this last week as well. Right now we are implementing from 21 to 2026. And what has been the analysis? What has been the performance of this kind of a system? Right? The last point we discussed last week was, for 5 years, 2016 to 2021, inflation rate on an average was around 3.7%. Inflation rate was on an average around 3.7%, which is much, much lower than what it was before the targeting was implemented, and it is somewhere in the range of 4% target that was given by Government of India, which means for 5 years this system of using headline inflation has been successful in India. We have been able to control inflation. Why do you want to change it then? If something is working in your favor, it is working correctly, why do you want to fix it? It doesn't require any fixing. That is the second argument in favor of headline. Third one, we are basically coming out of impact of the pandemic. All of you will agree with me, right? 2020, there was a COVID-19. It extended to 2021 as well. Right now, we are coming out of pandemic. We are recovering from the impact of the pandemic. And because we are recovering from the impact of the pandemic, it is not a time to suddenly change the policies of the central banker. We should wait for the recovery to completely take place. We should return on a higher growth path, and maybe then we can decide whether should we take the headline inflation or the core inflation. So these are some of the points in favor of using headline inflation. But what are the points in favor of core inflation? Why should we use core, not headline? Point number one, headline inflation, please understand, straightforward, includes certain commodities, certain products whose prices are unstable. I repeat, I'll repeat the statement. Headline inflation considers some of the commodities whose prices are unstable. And what is the problem here? What is the problem? Let's imagine, understand this carefully. Suddenly there is an impact of let's say monsoon, right? Either the monsoon is very high or monsoon is very, very less. Now, when the monsoon is very high or very, very less, what do you think will happen to production? What do you think will happen to production? The production automatically will come down. And when the production will come down, what will happen to the market prices and inflation? Suddenly, I'll write inflation now. Inflation will start going upwards. Inflation will go beyond control. And if inflation goes beyond control, RBI doesn't have any option but to increase interest rates in order to control inflation. But you tell me, simple question to all of you, you tell me, is there any control of RBI on agriculture sector? Think of it. Is there any control of RBI? Can RBI intervene on the supply side? No, RBI cannot intervene on the supply side. So the problem is this. The argument is the role of RBI is very much limited, right? Especially when the inflation is being caused from the supply side. And in that situation, suddenly the rainfall is lesser or very higher, RBI has to change policies. And let's say hypothetically, at the same point of time when inflation is very high, we will import a lot of food grains. We will import, government will allow, let's say we will import, right, within a month or two, we will import a lot of food grains. And if food grains are imported into India, what will happen to inflation? Inflation automatically will come down. So now what RBI has to do? RBI again has to, right, reduce the interest rate in order to promote growth. So all I'm trying to say is, in 2 months, in a span of 2 months, RBI has once increased interest rates and RBI once has reduced interest rates. Is it not a volatile policy? I hope you understand my statement. Is it not unstable policy making of RBI? Now you tell me, a central banker such as RBI, institution of government, is making unstable policies. Within 2 months, it has increased as well as decreased. Do you think market will be happy with such a situation? If you are a market participant, will you have more confidence on the central banker? Argument is no. Right? You want to have stable policies. You do not want to have unstable policies. You want to have stable policies. That is the reason, if you basically have headline inflation, suddenly inflation will go up, come down, again go up, come down, because food and fuel article prices are unstable. Now, what if you replace headline inflation with the core inflation? Don't you think in that situation, you will have more stability in terms of inflation rate? And if there is a stability in terms of inflation rate, what about stability in the policy making of RBI? Right? Even the RBI's policy will be much more stable. This is the reason why they say we should go for core inflation. We should not go for headline inflation targeting. Any problem with any of these points that I've discussed? Let me know. Any problem with whatever I've discussed so far? Core inflation is a much better indicator compared to headline. Headline inflation considers commodities whose prices are very volatile. And whenever there's a volatility, right, in the market, the policy making will be affected, and that will create instability even in the decision making of RBI. Okay, right? So these are the points. And whenever you say repeat, you tell me what point should I repeat. If you simply say repeat, I will not understand where should I repeat, what point should I repeat, right? So food and fuel prices affect the common man, right? Some of you are saying, sir, first point, right? Food and fuel prices will affect all of us, and headline inflation will consider that. You do not want to make a policy based on headline. You want to shift to core. Core does not include food and fuel. Then basically argument is include fuel and food and then use that for policy making. Okay, done. So this is a discussion regarding headline versus core, and I'll repeat it again. In case of India, we use headline CPI. I repeat, we use headline CPI for policy making. Now next point is, if there is inflation in the market, what is the impact of it? What is the effect if the inflation is there? Let's start. First point, it will reduce the purchasing power of consumers. It will reduce the purchasing power of consumers. Any problem with the point number one? We have been discussing this point at least for 10 times now. It will reduce, right, the purchasing power of consumers, because I told you this last week also. If you have 100 rupees and the price of the commodities is 100 now, and next year because of inflation it becomes 110, then automatically the purchasing power of the money that you have has gone down. So reduces the purchasing power of buyers or consumers. Point number two, it will reduce the real rate of returns. It will reduce real rate of returns. Now, what do you mean by real rate of returns? Let me ask you a very simple question. Imagine you have 1000 rupees. You, rather than purchasing set of goods and services, I hope you understand this. You have 1000 rupees. Rather than purchasing a set of goods and services, you will take this 1000 rupee, go to a bank, deposit 1000 rupee. And let's say after 1 year, you will get 4% rate of interest. You will get 4% rate of interest, which means 1000 rupee plus 4% will be how much? 40 rupee. So how much money you will get after 1 year? You will have 1040 rupees. And at the same point of time, that is, rather than purchasing a set of goods and services, you keep money and you will get 1040 after 1 year. During the same period of time, the inflation rate is 10%. Inflation rate is 10%. Now, can I simply say, because of 10% inflation rate, the set of goods and services which was costing you 1000 today, after 1 year will become 1100 rupees. Any problem with this calculation? Let me know. Right, point number one, you have 1000 rupee, you will go to a bank, deposit this 1000 rupee, and bank will give you 4% rate of interest, which means after 1 year you will have 1040 rupees. And on the other hand, the 1000 rupee you could have used to purchase a set of goods and services. In the same 1 year, the prices will increase by 10%. That is inflation, which means the price of the same set of goods and services which was 1000 today, after 1 year will become 1100 rupees. Now tell me, based on this discussion, by keeping money in the bank, have you earned any real rate of returns? I'll repeat the statement. By keeping this 1000 rupee in the bank, have you earned any interest, real interest? Real interest means the 1000 rupee you could have used to purchase the basket of goods and services today. You did not do that. You kept it in the bank. And the bank says, congrats sir, I will give you 40 rupees after 1 year. But during the same 1 year, prices have increased by 10%, which means you are not earning interest here, real interest. What do you mean by real interest? After adjusting for inflation. after adjusting for inflation. On paper, you will have 4%. I'll repeat the statement. On paper, you will earn 4%. But when you adjust that 4% with inflation rate, how much are you earning? You are not earning anything. Rather, you are paying 60 rupee extra from your pocket to get the same set of goods and services after 1 year. This is basically called as real returns. In this example, are there any real returns? Absolutely no. Your real returns is minus 60 rupees. Minus means what? It indicates from your pocket you are giving 60 rupees, even though you are saving money. Even though you are saving money, keeping in the bank, from your pocket, now you are paying 60 rupees. And why is that? Why is that happening? Thanks to inflation rate. Thanks to inflation rate. Now, can the opposite also happen? I hope you understand the next point. Can the opposite also happen? Of course, yes. Let's take another example. You will take 1000 rupee. Rather than purchasing basket of goods and services, you will keep it in the bank. You will get 4%. And during the same period of 1 year, inflation rate is 2%. Is it okay? Inflation rate is 2%, which means after 1 year, you will have 1040 rupees. And right, the 1000 rupee basket of goods and services, prices will increase by 2%, which means the basket will cost you 1020 rupees. And how much money you are earning now? What is your real interest rate? Real interest rate is 20 rupees, which is nothing but 2%. Any problem in calculations here? Any problem in the calculation? Let me know. Can I write it in the formula? Can I put it in a formula now? Same thing that I've discussed here. It is given in a picture. Please have a look at it. I have taken 1000 rupee. They have taken 50,000 rupee. Nothing else is changing. I have taken 1000. They have taken 50,000. And numbers are changing. But logic remains the same. The formula is very simple here. I'll write it here. The real returns or real interest rate is equal to nominal interest rate, nominal returns or nominal interest rate minus inflation. Minus inflation. Any problem here? Any problem with the formula? The formula is okay with all of you? Real returns or real interest rate is equal to nominal interest rate minus whatever is the inflation rate. Now, please look at the situation in the market. What is the latest inflation rate? Somewhere around 3 to 4%. This is the beauty. What is right the inflation rate right now? Somewhere around 3 to 4%. And right when you keep the deposits in the bank, how much the banks are offering? Around 4%. SB account, around 4%. Now, if you basically account for inflation, how much is your real rate of returns? How much is your real rate of returns? Almost equal to 0. I'm not saying equal to 0, almost equal to 0, because if the inflation rate is 3.5% for the month of April, then your returns will be 0.5%, but almost equal to 0. Right? That is the application part of it. Application part of the studies that you're doing. Now, please look at yourself. Many of you, not all of you, many of you, I'm pretty sure you have kept your salaries in savings account itself. I'm pretty sure a large chunk of you who have salaried account would have kept your salary that you people are receiving in your savings bank account, without realizing, yes, there is an inflation rate in the market, and that inflation slowly and steadily is eating away whatever your returns going to get. Right? So that is the application part of inflation. Please understand it. So first point is what? Purchasing power will come down. Second one is real rate of returns will come down. Third point, any country with higher inflation rates, exports would be affected. And don't use the calculations here. Let me simplify this very simply or fundamentally. Right? Your friend is back. You're manufacturer of this bottle. Okay, you're a manufacturer of this bottle. Imagine, as a result of inflation, the manufacturing cost of the bottle goes up by 10%. Simple, by the way. Imagine, as a result of inflation, the cost of manufacturing goes up by 10%. Now, flow chart, right? Start having a supply chain here. If the manufacturing cost up goes up by 10%, what will happen to market price? Tell me, what will happen to market price of the product? Market price will go up. A simple question to you. When the market price will go up, you will be able to export more of this product, or your exports will go down. Let me ask it again. I'll repeat the question. With higher market prices, will you be able to export more or lesser now? Your exports will start going down. Any problem with this? Exports will start going down, right? Why? Imagine your competitor is there. Your competitor is there in China. Product prices are almost similar. In China, the prices will increase by, let's say, 4%. But your products, the prices are increasing by 10%. So obviously, as a result of the higher market prices, your export competitiveness, I'm using a technical term now, your export competitiveness will go down. If I'm the importer, imagine I'm sitting in USA, you are also selling the product to me, but your prices have increased by 10%. Somebody else's prices have increased by 2%, 3%. Will I prefer your product or their product? Automatically, I'll prefer the other exporter's product, not your product. Right? So argument is simple here. As a result of this, export competitiveness will go down. And finally, it will also have an impact on investment scenario. It will also have an impact on investment scenario. What do you mean by investment scenario? Let me explain this. Imagine you have 100 rupees. Let's take a simple number. Imagine you have 100 rupees. You have two options. One, you can use the 100 rupee, keep it in the form of, let's say, fixed deposit. Keep this 100 rupee in the form of fixed deposit. I will not even take savings bank account, because savings bank account, if you account for inflation, you will not earn anything. And the other option is you can invest in gold. Now let's say fixed deposit will give you 6% rate of interest. Now tell me, think like an investor. Will you prefer to invest on a fixed deposit, or will you prefer to invest on gold? I'll repeat it again. You have 100 rupee. Again, don't ask me, sir, how much gold will I get in 100 rupee? That's not the point. Will you prefer to invest this 100 rupee in the fixed deposit or in a gold? Those who are saying gold, good. Those who are saying gold, you're absolutely correct. People prefer to invest on gold, not in fixed deposit. Some of you will simply say, but sir, in my home, they are doing it. They are doing it in fixed deposit. Then tell them. Why? I'll tell you. The demand for the gold generally is higher. Simple idea. Demand for the gold is generally very high. And historically, if you see, historically, don't look at 2 days, don't look at 3 days. Look at historically. Historically, when you look at the gold prices always have increased. Done? If you don't trust me, after the class is over, just check it. Historically, if you see the price of the gold prices always have increased. Whereas, in case of fixed deposit, some of you will say, but sir, I will earn 6%. My dear, what if inflation is 5%? Tell me, what if inflation is 5%? What if inflation is even 3%? Right? When the inflation is 3%, your real rate of returns is how much? 3%. But if you invest in the gold, just check what was the price of the gold 10 years ago, what is the price of the gold today. And that is the precise reason generally, remember this, generally, whenever inflation rate keeps on going up, whenever inflation rate is a concern, people rather than investing in other instruments will start purchasing lot of gold. I'll repeat it. Whenever inflation rate becomes higher, sustainably very high, whenever there's a concern about higher price levels, RBI, European Central Bank, right? Let's say even Federal Reserve of USA, investors in the market, rather than investing in any other instrument, they would prefer gold. They will start purchasing lot and lot of gold. And what will happen to the price of the gold during inflation rate? Prices of the gold will be higher. Check it, just check it, right? And traditionally the price of gold always have become higher, right? On an average the price always have increased. So would you want to invest in one instrument on 3% real returns, 4% real returns, or invest in the gold which historically will give you good returns, higher returns? You will always prefer the investment in the gold. Done, right? So what is happening here, right? All I'm trying to convey is what is happening here. Rather than keeping fixed deposit, if you purchase a gold, don't you think capital formation in India would be affected? Let me check how many of you are revising. Rather than investing in, right, FD, rather than keeping money in the bank, if you start purchasing gold, and by the way, some of you will ask, or what is the problem purchasing gold? My dear, we import most of the gold. We do not produce gold in India. We import most of it, right? So what would happen simply? Rather than keeping an FD, which would contribute to investment, which would contribute to capital formation, you are investing your money, you are basically diverting your money into some other assets which are majorly imported into India. That would have an impact on investment in India. Okay. And again, right, some of you will simply say, but sir, is government of India not aware of it? Of course, government of India is aware of it. Later, we'll have a discussion. There's a concept called a sovereign gold bond. We'll discuss that. Have patience. For addressing this only, Government of India introduced a concept called as sovereign gold bonds. We'll have a discussion regarding that as well. Okay, so that is basically the impact of inflation on, right, the investment scenario in the domestic market. So these are the four very important effects of inflation. Now, none of you have asked, but let me ask you a very simple question. Don't you think, looking at all of this, one of the points that will basically, right, start arising in your mind is, if there are so many problems with inflation, why are we targeting inflation at 4%? Think of it. Why are we targeting inflation at 4%? Why not simply target inflation at 0%? There should be certain reasons. I understand there should be certain reasons. What are the reasons? What are the benefits of inflation? What are the benefits of, right, healthy inflation? That is very, very important. What are the benefits of healthy inflation? Why should we have healthy inflation? For example, in case of India, 4%. If inflation is around 4%, we are not concerned. We simply say, okay, it is required for the economy. Why? Point number one, whenever there is inflation, it generally indicates growth in the economy. It is an indicator of growth in the economy. Any problem with the point number one? Point number two, whenever there is an inflation, it is also generally indicator of higher demand in the economy. It is also an indicator of higher demand in the economy. Third one, whenever there is inflation, it is preferable because inflation is a better indicator compared to deflation. I'll repeat the statement. Inflation is a better indicator compared to deflation. Right, sir? How? Last week I told you this. If the price of this product falls from 100 rupee to 90 rupee in a week and you want to purchase this bottle, I hope you understand this. Price of this bottle falls by 10 rupees in a week. Will you purchase it right now or will you wait for one more week to see what will happen to the prices? I hope you understand my point here. Right, the price of this bottle will fall down by 10 rupees in a week. Will you wait for one more week to see further decline in the prices, or will you jump and start purchasing everything today itself? Most of the consumers in the market will wait. I hope you understand. Right? Some of you will simply say, no, sir, I'll purchase today only. No, everybody will not do that. Most of the people in the economy will wait. They will wait to see what will happen, right, one more week. Because in the last week, it has fallen by 10%. Right? Before that, it has fallen by 2%. So there might be further decline in the prices. So let me wait for one more week. And if there's a further decline, then I might purchase the bottle. So what will happen here is, basically, if there's a deflation, it will postpone the consumption. I'll repeat the statement. If there is a deflation in the economy, it may simply postpone the consumption. Rather than that, if there is an inflation, from last week to this week, the price have increased by 2%. Will you wait for one more week? Think of it. Right, from last week to this week, the price have increased by 2%, 3%. No, you will not wait for one more week. Why? Your expectation is if I wait one more week, the prices might further increase by 2%. So what you will do? You will have a consumption demand in the market at that point of time. So inflation is always a better indicator compared to deflation. So having inflation is better. Deflation will lead to postponement of the demand. Right, so these are some of the reasons why it is better to have a healthy rate of inflation in the market. Done. Right, so these are the points. Any issue so far? If you have any issue, let me know right now. When I ask you, please ask the questions right now, or I'll go to the next point. Third point. What is this third point? A country which experiences higher inflation rate, the exports would be affected. What is the meaning of it? Let's take a simple example. Imagine this bottle is manufactured by you. It is also manufactured by your competitor who's sitting in China. Now, let's start. In your market, that is, let's say you're from India, the prices will increase by 10%. Inflation rate is 10%. In China also inflation rate is there, let's say 2%. Now, if the prices of the bottle is almost similar, I'll not even write the prices. I'll use a statement here. If the prices of the bottle are almost similar, please look at the inflation rate and tell me, don't you think your products will become much more costlier now? I hope you understand. Don't you think your product will become much more costlier now compared to, let's say, a Chinese product? And when your products become much more costlier, right, what will happen to your exports? You'll be able to export more and more. No, your exports will start coming down. Your exports will go down. Export competitiveness will go down. Okay. What is undervaluation of currency? My dear, we are not discussing about currencies today. Right? We will have a discussion. Don't worry. Have patience. This is my 5th class. We'll have a discussion regarding exchange rate later. Have patience. Okay. Okay. Done. Let me go to the next point here. How do you control inflation? We have discussed, right? Inflation is happening. These are the causes. These are the problems, etc., etc. How do you control inflation? Let's start. And again, this is my advice to all of you. Do not by heart everything. Do not by heart everything. Not required. For example, if I say there is, let's say, there is a cost push inflation. There is a cost push inflation. Now tell me, and again, please understand, the cost push inflation could be caused because of multiple reasons. It could be because the crude oil prices have become costlier. It could be because labor prices have increased, raw material cost has increased, the government has increased taxation, etc. There could be multiple reasons as a result of which there is a cost push inflation. Now, don't you think if you know the cause of this inflation, you can simply take a measure or a policy to address this inflation? Let me know. That is where your intelligence is required. Do not buy at everything. You know what is the cause of inflation. And if you know what is the cause of inflation, can you take certain policy? Can you implement certain measure in order to control inflation? Of course, yes. That is the reason. Do not buy heart everything. Understand the concept, then take certain appropriate measures or implement certain steps so that inflation will come down. Now, have a look at this. How do you control inflation? The government as well as RBI will have to reduce money supply. Now, tell me, has RBI done this in the recent time or not? Has RBI done this very same measure in the recent times or not? Please check what has been the stance of RBI. What has Reserve Bank of India done in the last 1 year? It has consistently, right? It has consistently or continuously from last year May has kept on increasing interest rates. Is the logic okay? Some of you are using technical term repo rate. I will not use it today. I will use it next time when I discuss RBI. So consistently, what has RBI done? Inflation rate is there. I have to increase the interest rate. So RBI has consistently increased the interest rates. So that is first measure. Second one, government will also have to reduce the expenditure. But some of you will simply say, sir, why are we not doing this? Some of you will have a very valid question. You say government has to reduce the expenditure, but we are seeing that in recent times, inflation rate is higher, government is spending more and more money. The problem is very simple here. The government is taking a counter-cyclical fiscal policy. All of you remember this? Government is taking a counter-cyclical fiscal policy. From 2020, there has been a concern. Even before there was a problem with the Indian economy, from 2020, there has been a concern in the Indian economy. What was the concern? There was a recession. There's a slowdown, then recession. Now you tell me, RBI will also reduce money supply continuously. Government will also reduce the expenditure. Don't you think that will become a pro-cyclical policy during recession then? Is the logic okay? Right? That will become a pro-cyclical policy during a recession. Would you prefer a pro-cyclical policy during a recession? No. You should simply say, no, sir. That will lead to higher recession, severe recession. We might enter even into depression. So that is the reason government, though it is an option, government has to reduce expenditure in order to control inflation. But right now, our focus is on recovery. Third one, government will increase the income tax rate. What is the impact of it? Please go back to the idea of disposable incomes. Disposable incomes, right? If government will increase the income tax rate, what will happen to disposable income? Disposable income will go down. And when the disposable income goes down, the demand for the goods and services automatically will go down. Next one, you and me should start saving more money. Rather than spending more money, we should start saving and saving more amount of money. And when we save money, expenditure will come down, demand automatically will come down. And finally, increase the overall production in the economy. Because one of the reasons why inflation happens is the demand is greater than supply. Simple idea. Demand is greater than supply. Now, what if I start increasing the supply? If you increase the supply, automatically we will be able to meet the demand and inflation rate will start coming down. Right? So these are the various measures. Again, sir, are these the only things? Some of you will ask, are these the only things we can control inflation? Of course, no. Tell me, government should allow easier imports of goods or services in order to control inflation. Can this be a possibility or not? I hope you understand. Can this be one of the recommendations? Of course, yes. On the other hand, government should also promote in different situation, not in the same situation. Government should also promote more and more exports in order to stabilize the supply of the commodities in the market. So I hope you understand this. It all depends on the context. It all depends on the context. How? Some of you will simply say, sir, how imports will control inflation? I'll give a very simple example. Let's say hypothetically, underline the term hypothetically. Let's say hypothetically, monsoon that we're expecting from the beginning of, right, let's say first week of June, there is a delay in monsoon. And after a delay also monsoon will come, but lesser amount of rainfall. What will happen to various agriculture commodities production? The production of agriculture commodities will automatically come down. And when the production will come down, it will start contributing to inflation. Let's say supply of wheat is less. Supply of rice is lesser to the market. Supply of sugar is lesser to the market. Now, at that point of time, can I simply say, rather than promoting exports, we should import more rice into India. Rather than promoting, let's say, agriculture commodities such as vegetables, onion, we should import onion into India. We should import pulses into India in order to ensure supply will increase. Hence, right, the market prices will stabilize. Any problem with my statement here? Any problem with the statement? Let me know. And again, please understand, go by the situation. Do not decide. Go with the context of the situation. If the context is this, based on that, you decide what should be done. Okay. Any problem? Shall I go to the next one? Fourth point. Households should start saving more. My dear, what I'm saying is, if your income, disposable income is 100 rupee, as of now, let's say you're spending 90 rupees, you're saving 10 rupees. I am saying reduce this expenditure to, let's say, 60 rupees. Increase your savings to 40 rupees. Now, when you increase your savings and reduce expenditure, what will happen to demand? What will happen to demand? Demand automatically will go down. And when the demand goes down, what will happen to inflation? Inflation will also go down. Okay, right? So third point, again, you are asking every point. So third point. So second point, then what is the point of discussing it again? So third point, if government will increase the income tax rates, your disposable income will go down. And when your disposable income goes down, automatically the demand for the goods and services will go down. Okay, right? So these are the things which you can use. Again, please understand, it all depends on the context. I'll repeat, it all depends on the context, right? You cannot simply say all these will be uniformly applicable in every situation. Absolutely no. It all depends on the context. How do you control inflation? These are some of the measures. Other concepts we have discussed that last week. Even we have discussed the concept of Phillips curve last week. We have discussed this. Now, many of you have been asking, sir, base year. Let's start. What is the concept of base year? And actually, I'm surprised. I'll tell you one point. Think of it. Whether I'm valid in raising this concern or not, you tell me. Whatever points I've written here, are these not the same points that we have seen earlier as the causes of inflation? This is where you are expected to revise, my dear. Tell me, are these not the same as the causes of inflation? Sir, you're wrong. These are nowhere written as the causes of inflation. My dear, then what have you done with this particular PPT when you have received it? You tell me. What have you done with this particular PPT? You have not even seen what was discussed in the PPT. Government expenditure will cause inflation. And I have written in the solution, reduce government expenditure. RBI will increase money supply, which will cause inflation. I said RBI should increase interest rate, reduce the money supply, etc., etc. Same things, opposite of this I've written in another slide. And you're confused there. So just think of it. Right? This is the concern I generally have with the students. What we have discussed 4 days ago, 3 days ago, you don't remember it. That is a cause of concern, my dear. Okay. Let's go ahead. Next is the concept of nominal, current, real, constant, and the concept of base year. Idea of base year. Now, let's start. Let me ask you a very simple question. Imagine there are two students, A and B. Imagine there are two students, A and B. I'll say that A has scored 300 marks, B has scored 500 marks. Okay, there are two students, A and B. A has scored 300 marks, B has scored 500 marks. And my question to all of you is, between A and B, who has scored more? Let me see. Between A and B, who has scored more? Those who are attending repeated, there's a repetition for them, don't worry. Right? Generally, most of you will jump to, right, let's say B. And most of you are doing that. Most of you are basically saying, right, yes sir, B has scored more. But what if I say A has scored 300 out of 500, B has scored 500 out of 1000. Now you will basically calculate percentages and come to conclusion, sir, in that case, A has scored better. A has scored better. All of you will agree with me now? Now, what is the point I'm trying to make here? You need always a number to compare. You always need certain number to compare against and derive certain result. For example, let's say for the financial year 23, I'll simply tell you GDP of India is $1 billion. Again, it is not $1 billion, it's around $3 trillion. I'm just giving you a simple number. I'm saying for financial year 23, GDP of India is $1 billion. Now tell me, is this $1 billion good? Is $1 billion very bad? Right? Is $1 billion the target that we have set up? What is your conclusion? Can you conclude anything beyond the fact that the value is simply 1 billion? Tell me, can you make a conclusion based on this number? Absolutely no. You will have to make a comparison. All of you will agree? You'll have to make a comparison, only then you can tell me whether this $1 billion is a good number or a bad number. And what if I say, what if I now add the data here for previous financial year, that is for financial year 22, the GDP value was $0.8 billion. For previous financial year 22, the value of GDP was $0.8 billion. Now, don't you see the number has increased? Right? Don't you think, okay, compared to previous year, we have done better. And I'm not going to calculate any numbers here. Have patience. Have patience. There's a problem even in this. Right? So based on this, now you can make a comparison. But there is one problem even in making a comparison. What if I were to say, only one good was produced here and only one good was produced here? Simple number, simple idea. Only one good was produced in financial 22 and only one good was produced in financial 23. And because of inflation, the GDP has increased. Any problem here? Because of inflation, GDP has increased. Now, how comparison? How do you make comparison here? Don't you think there's a problem? We have to address the problem. The problem is inflation. That is, again, I'll repeat the point here. Understand the logic here. Whenever you talk about GDP growth rates, I'm not going to talking about GDP. I'm talking about GDP growth rates. The one problem that you will generally face is from 1 year to next year, there is inflation rate. Can you make a direct comparison without adjusting for inflation? Think of it. Can you make a comparison of a GDP of 1 year to another year without accounting? Accounting means adjusting for inflation. You cannot do that, because if you make a comparison without adjusting for inflation, that is not a right data. Because when you talk about inflation, the value of the good has increased. Quantity may or may not have increased. Is it okay? The example is right there, right in front of your eyes. I've produced one good here, one good here. The market price has increased. And the reason is what? Inflation. Has the productivity of the economy increased? Has the overall goods and services produced, have they increased? May or may not have. You will only be able to find it out when you adjust GDP numbers for inflation. Now, one more challenge, right? First challenge is what? Only GDP value, you will not be able to get any result. Any inference you cannot make. So what we have done? We have taken the previous year's data to make a comparison. But there is one more challenge there. That is, from the previous year to the current year, there is inflation rate in the market. Now, how do you address the inflation? That is the third challenge that you'll face. And for this only, we use a concept of base year. I will tell you about base year. Have patience. Listen to the lecture first. I'll tell you about base year. For this only, we use base year. Now, what is a base year concept? You want to adjust inflation rate in financial year 22 so that you can make a comparison between 2 years, right? Again, you want to adjust for inflation in financial year 22 as well as financial year 23 so that you are taking out the impact of inflation and you're comparing the GDP value. You're simply comparing the GDP value. Otherwise, what will happen? Inflation is already there in the market. You're counting the inflation as well in the GDP value. For this reason, we use a common reference point. What is a base year? Base year is the common reference point. Sir, what is the meaning of common reference point? Let's take a simple example. This bottle was manufactured in the base year. This bottle was manufactured in 23 as well as 22. Whatever was the price of the bottle in the base year, I repeat, whatever was the price of the bottle in the base year, you take the same price, use it to calculate GDP for financial year 23 as well as financial year 22. Is it okay? I'll repeat it again. This bottle was manufactured in the base year. Whatever is the price of the bottle in the base year, use it to calculate GDP for financial year 23 as well as financial year 22. Now, let me show it in real time. Imagine the price of a product in the base year was a 10 rupee. And right now, what is the base year for GDP calculation? GDP calculation, the base year is 2011 and 2012. Let's say price of this product was 10 rupee. Now, for 2019 and 20, price has increased to 12 rupee and the production is 15 rupees. And have a look at this. If I simply calculate GDP here, 12 into 15, what is the GDP? 180 rupees. And because we are using the market prices, whatever market prices existed, right? Whatever is the market price of the product in that year, because I'm using that market price, this is called as GDP, that is nominal. GDP that is nominal, that is nominal GDP, or else GDP at current market prices. And in the next year, that is let's say 20 and 21, the market prices because of inflation has increased to 15 rupees. I will simply calculate 15 into 20. I will get 300 rupees GDP. This is also nominal GDP. This is also GDP at current market prices. If I compare both of these GDP values, don't you think because of inflation, whatever data you get will be, right, not correct? Think of it. I'll repeat the statement here again. I've calculated GDP for financial year 20 as well as 21. And if I make a comparison, is it a correct comparison? Is it an appropriate comparison? No, the comparison is not correct. Why? The market prices have changed. Because of inflation, market prices have changed. So what I'll do? I will simply choose 1 year as a reference point. Common reference point, that is a base year. And what is the price of the product in the base year? 10 rupee. Now shift to the right side of the table. Please shift to the right side of the table. I'm talking about this. What will happen now? Once you have chosen the base year price, whatever was the production, keep it same into the base year price. For both the years, whatever was the production, keep it same. But take the base year pricing. And if you use that, you will get GDP at base year price, that is a constant price, 150 rupees for 19 and 20 and 200 rupees for 20 and 21. Now, because I've taken the base market prices or base year prices, is there any impact of inflation on these values of GDP? Let me know. If you're following, it is easier. Because I've taken the same base year prices, is there any impact of inflation on these GDP numbers? Absolutely no impact of inflation. Now make a comparison. Simply now make a comparison. 150 rupees last year, that was the value of GDP, and 200 rupees this year, that is the value of GDP. Now, whatever is the growth rate, for that you will use this data and calculate the growth rate. Any problem? Let me know right now. Any problem with this idea? Why do we use a base year? Used as a common point for us, which will help us in removing the impact of inflation and will help us in making comparison. Right now, next point, before you start asking me, sir, on what basis we will use or we will basically decide this is a base year. Now, let me ask you a very simple question. I am asking a counterpoint to you. Can we use 2020 prices as base year? Think of it and let me know. Can we use whatever the market prices in 2020? Can we use those market prices as base year? Your answer should be no. Why? Sir, there was a pandemic. There was a pandemic. And understand the logic here. What we do is, we will take certain years. We will not directly go to 2011 and 12 and say this is base year. No. We will take certain set of years. We could say 2011 and 12, 2013 and 14, 2008 and 9. And when we have choices like this, we will see and choose one year for which data is available. That is one point. For which data, different points of data. For example, 2011 and 12, census data is available, right? Employment, unemployment data was available earlier. Different sets of data was available for 2011 and 12. And point number 2, that is very, very important. That year should not have experienced, right, instability. I'll repeat the statement. That year, that is the year that we are trying to choose as a base year, that year economy should not have experienced instability. For example, 2020, was the economy stable in 2020? Answer is absolutely no. What about 2021? Was the economy stable even in 2021? No. What about 2008? What about 2008 and 2009? Was the economy stable back in 2008 and 9? Again, no. So argument is simple here. The year that we want to choose as a base year, in that year we should have lot of data. Data related to economy should be available to us. And point number 2, the economy should not have experienced volatility or instability. Right? So when we have set of years, we'll try to choose that year which will satisfy these conditions. Any problem with the idea of a base year? Let me know right now. Right? Any problem with the idea of a base year? That is the reason we choose a base year in calculation of CPI. We choose a base year in the calculation of WPI. We choose a base year in IIP, GDP, etc., etc., etc. In all these indicators, we always have a concept of base year. Right? What is the idea of a base year? It's a common reference point for us. We will use the common reference point, that is that year's prices, in order to calculate and remove the impact of inflation in next years. That is the concept of base year. And whenever I calculate GDP using the market prices, the current market prices means, let's take a simple idea. This bottle right now, let's say market price is 100 rupees. I hope you understand. This bottle this year market price is 100. So if I take this 100 rupee to calculate GDP, that is called as the nominal GDP or, right, the current GDP. Any problem here? If I take the bottle price, whatever is the market price today, right, that is in this year, and calculate GDP, that is called as a nominal GDP or GDP at current market prices. And if this bottle price in the base year was, let's say, 80 rupees, I will use 80 rupees to calculate GDP, then that GDP is called as GDP at constant prices or real GDP. Can I go forward here? Why 2008 is an unstable year? My dear, in 2008, there was a global financial crisis. Table. I'll repeat the table again. Do not by heart the table. UPSC will not ask you the table. And you can check many books. Many books have not given the discussion regarding the table, but please understand the logic here. what I've done is I've calculated GDP for 2 years, 2019 and 20 and 2020 and 21. And when I'm calculating GDP for 2 financial years, I've taken whatever was the market price of the product in that year. And when I use that to calculate GDP, right, this is called as a nominal GDP or GDP at current market prices. Can I make a comparison directly for these two GDP numbers? If I make a comparison directly, what about the impact of inflation? Price of product in, right, 19 and 20 was 12 rupee and in 2021 was 15 rupees. That is nothing but inflation. So can I make a direct comparison? That will be unfair comparison because there is an impact of inflation in the market prices. And that is the precise reason what we do is we will take the market price of the product. I repeat, we will take the market price of the product in the base year. Whatever is the production data, we will use it to calculate GDP. And because I'm using the base year price, the GDP is called as a GDP at constant prices or real GDP. GDP at constant prices or real GDP. Okay, right? So that is basically the concept of base year, nominal, current or nominal or current GDP, real or constant GDP. Now let me ask you a very simple question. Think of it and let me know. If I use this data, that is, let's say from 2011 and 12 to 2021, etc., like this, is it not that I'm simply measuring inflation here? Think of it. The market price of the product in the base year was 10 rupee and the market price of the product in 2021 was 15 rupees. Is it not an indicator of inflation? Is the logic okay? Is it not an indicator of inflation? Some of you are saying no. My dear, the bottle price in the base year was a 10 rupee. Now it is 15 rupees. Is it not an indicator of inflation? It's very, very simple, by the way. It's not even complicated. It is an indicator of inflation. And that is the reason I'll introduce one more concept to you. That is the idea of a GDP deflator. Important. Okay. Right. There is one more concept of GDP deflator. GDP deflator is also referred to as implicit price deflator. Why? Please have a look at the formula. Please have a look at the formula. GDP deflator is equal to the nominal GDP divided by real GDP. Now tell me, when you calculate nominal GDP, will you use a base year prices or current year prices? I'll repeat it again. When you calculate nominal GDP, will you use a base year prices or current year prices? We will use current year prices. Agreed? Current year prices. And when you calculate real GDP, you will use base year prices. Which means in the numerator, you have a GDP value where current market prices are used to calculate GDP. And in the denominator, you will use the prices which are base year prices. Now, if I make a comparison of nominal GDP, right, compare or divide it by real GDP, and I'll simply tell you the data. Please have a look at it. Let's take a number and substitute and find out. Don't complicate it. Let's make it very simple. Imagine we are calculating for 20 and 21. So the GDP at current market prices, that is nominal GDP is 300 rupees. And GDP at constant prices, that is base year prices, is 200. Substitute both of them. Substitute. So I'll substitute in the formula here. That will be 300 rupees divided by 200 rupees. That will be how much? It will be 1.5. I can write it as 1.5 or I can also write it as 150%. Any problem with this? I can write it as 1.5 or I can also write it as 150%. But what is the meaning of it? What is the meaning of this number 1.5 or 150%? Can I put it in a statement and say the market prices today have increased by 50% compared to base year? I'll repeat the statement. Think of it and let me know If you do not understand, I'll repeat it right now. I'll repeat it, by the way. Compared to the base year prices, the market prices today have increased by 50%. Any problem in understanding this statement? It is there right in front of you. Right, in the base year, the prices were 200 and now the prices have become 300, which means compared to base year, the prices have increased by 50%. Now that's the reason GDP deflator is also an indicator of inflation. That is also right. GDP deflator is used as an indicator of inflation. Any problem? Let me know right now. And some of you are asking, sir, is it 50% or 150%? My dear, I'll repeat the statement. Understand the statement first. I am saying compared to base year, prices have increased by 50%. And if you want to put it as 150%, I can put it in this way. Compared to base year prices, the current year prices are 150%. The current market prices are 150% of base year prices. It's a basic English language statements. Please let me know if you are still confused. That is the reason I'll repeat it again. GDP deflator is also an indicator of inflation. And let me go to the next point. In fact, compared to CPI, WPI, GDP deflator is a better indicator. I'll repeat it again. In fact, compared to CPI, WPI, GDP deflator is a better indicator of inflation. Why? In case of CPI or WPI, we are having a basket approach. Basket approach means either we are considering only goods in WPI, which are 697 in number, or we are considering goods and services, but only limited to 299. Now understand the difference here. On one side, you are basically having a small basket, either 299 or 697. On the other hand, you are comparing GDP values. Don't you think when you say GDP, right? Don't you think when you say GDP, the whole economy is covered here? Let me know. The whole economy is covered when you say GDP, that is nominal GDP or real GDP. Right? So that is the reason, again, I'll repeat it. GDP deflator is a better indicator, much better indicator of inflation, even compared to CPI as well as the WPI. Now, started, right? Many of you have started typing. Then why are we not using it? I'll come to that right now. That is the next point. In such cases, automatically the argument will be, then why not use GDP deflator? Why do we always run behind either CPI or WPI? Now, simply tell me one point. Do you calculate GDP month-wise? Let's see how many of you think it through. Do you calculate GDP month-wise in India? No. Right? The shortest data for which you calculate, shortest tenure for which you calculate GDP is quarter. Shortest tenure. Right? That is for 3 months. Now your argument is, sir, if GDP deflator is a better indicator, let's use it for inflation indication. We'll decide all the policies based on that only. My dear, if you calculate GDP quarter-wise, then don't you think even the GDP deflator will be available quarter-wise? Is the logic okay? If you're calculating GDP quarter-wise, GDP deflator is also available quarter-wise. So your argument is, quarter-wise data is published, we will do the policies after 1 quarter. Don't you think that will basically delay the whole process? If you start running behind, right, GDP deflator to make policies, it is available after 3 months. You will have to wait for 3 months to come to a conclusion what has happened to inflation, then take policy decisions. Delayed policies. On the other hand, you tell me CPI and WPI. Is it published quarter-wise or monthly basis? Okay, so CPI, WPI, every month you will get this data. So because you have more frequency, the data is available much more frequently, that is on monthly basis it is available, right? You will prefer to use these indicators for policy making rather than GDP deflator. Any problem with this? Can I go to the next one? Can I go to the next one? This is basically the idea of a GDP deflator, right? In fact, based on this, the question was there in the GDP, right? When we discussed national income indicator, the same question was asked by UPSC. In the prelims, the same question was asked by UPSC. That is, right, if you remember the question, GDP deflator, right, basically means what? Right, it was a question on the ratio of GDP deflator. Okay, right, so GDP deflator is also referred to as one more name for this, implicit price deflator. Implicit means it is an indicator of price variation in the market. It covers the whole economy compared to CPI and WPI, which cover only part of the economy. Okay, right, so this is a discussion regarding GDP deflator. Sir, 150% is confusing, my dear. Forget about that. Forget about it. Price of the bottle now is 10 rupee. After 1 year will become 15 rupees. Question number 1. By how much percentage? Can you understand this statement here? By how much percentage price has increased? Price has increased by 50%. Any problem with this? Right, we are going to high school now. By how much percentage price has increased? 50%. Question number 2. The new price as a percentage is how much of the old price? Okay. The new price as a percentage is how much of old price? Answer will be 150%. That is exactly what I discussed some time ago. Instead of 10 rupee, it was 200 rupees. It was 15 rupees. Instead of 15 rupees, it was 300 rupees. Okay. Right. So this is a basic idea of a GDP deflator. It's a much better indicator, but this is not published on monthly basis. In fact, it is published by MOSPI, Ministry of Statistics and Program Implementation. It is published by MOSPI, Ministry of Statistics and Program Implementation, but quarterly wise. It is published quarterly. Okay. Done. Right. So this is a discussion of the inflation, other points, etc., in the inflation. Any point that some of you are saying, sir, one slide has been missed. Somebody said, sir, you have missed one slide. Okay, this one we have not discussed. Let's finish it off. This will be end of the discussion on inflation. Let's finish it off. One is called as an imported inflation. Second one is wage price spiral. Both are there in the current affairs. Let's try and understand. One is imported inflation. Second one is wage price spiral. Now let's start. What do you mean by imported inflation? Understand this. We have discussed this. Let me put in a statement here. Imagine you're manufacturing this bottle. Imagine you're manufacturing this bottle. But to manufacture this bottle, you'll import a steel. You'll import a steel to manufacture this bottle. Last year, the prices of the steel was, let's say, 10 rupees. Now, the price of the steel has become 18 rupees. Now, don't you think the import prices have increased, which will lead to higher market prices? Any problem? Let me know right now. The price of the import has increased, which will lead to higher market prices. And when the market prices will increase, it will contribute to inflation. But tell me, what is the reason, cause of this inflation? What is the reason or the cause of this inflation? Can I simply say imports? Can I simply say imports? The price of the imports has increased. As a result of this, right, it has caused inflation in India. This is called as imported inflation. This is referred to as imported inflation. Any problem with this? Let me know right now. This is referred to as imported inflation. Sir, can you connect it to current affairs? My dear, petrol prices, diesel prices, cost of transportation has increased. All of that is contributing to inflation. That is imported inflation. Can I go to the next point here? Can I go to the next point here? And here itself, I'll introduce one more concept. The price of the steel might be increasing because of two factors. One is the international prices have increased. One is international prices have increased. In the international market itself, prices have become costly or prices have increased. Another one, I will introduce a new concept. Rupee has depreciated. Rupee has depreciated. Now, do not enter into depreciation. Let me give a basic idea here. Imagine last year $1 is equal to 50 rupees. Now, $1 is equal to 70 rupees. Is the two equations okay here? Imagine last year $1 was equal to 50 rupees and now $1 is equal to 70 rupees. This is basically depreciation of rupee. Don't worry about definition. Don't worry what is causing it, etc. etc. Have patience. Later we'll have a discussion in detail about this. Now, if $1 is equal to 70 rupees, don't you think automatically you will pay more money to import steel? Right? Automatically you will pay more money, more rupees to import steel. And that is also one of the reason why imported inflation can happen. Right, so understand the logic here. There are two causes here. One, steel automatically has become very costlier. Last year the steel cost was $1. Now it has increased to $1.2, which means the import price has increased. But on the other hand, what if rupee has depreciated? Last year also steel price was $1. This year also it is $1. But because of rupee depreciation, now you will pay more money, that is more rupees, to import steel. That could cause imported inflation. So it could be because of one, it could be because of two, or it could be a combination of one as well as two. Has it happened? Has it happened in India? Of course, yes. Very, very recently, this has actually happened. Okay. So this is imported inflation. Next one, wage price spiral. Wage price spiral. Now, what is the side of a wage price spiral? Let's start with a very simple example. Again, understand the example. That should be more than sufficient. Let's start. Imagine you're a manufacturer of this bottle. I'm working for you. I'm working in your company. Now I'll come to you and say, I want more salary. Oh, okay. I want more salary. Now, obviously, you're a very good owner. So what you will do? You will increase my salary. That is wages. Now, when you increase my wages or salary, you tell me what will happen to cost of production. Follow the sequence. Follow the sequence. When you increase my wages or salary, what will happen to cost of production? It increases. Market price? Market price will increase. Inflation? Inflation will also increase. Now I am worker, right? I am a worker. I will look at the situation. The prices of goods and services, the prices have increased. And you have told me inflation will happen. Prices of goods and services have increased. Will I be happy with the same salary? Think of it. Will I be happy with the same wages? Of course no. What I'll do? I know you are very good owner. So I will come to you and I'll simply say, sir, please look at the inflation rate. Inflation has increased, so kindly increase my wages. So what you will do? You are a very good owner, so you will increase my wages. But same problem. When you increase my wages, what will happen to again market prices? Will increase. And when market price will increase, again inflation will increase. I will look at the inflation rate, again come to you. Now, can you see a pattern? Can you see a spiral? Spiral means a circle here. Can you see a cycle which is repeating again and again? Right? So this is called as wage price spiral. It is also called as a wage inflation. Wage caused inflation. That is, wages are increasing and inflation is being caused. Wage price spiral. Right? So that is basically one more right concept related to the idea of inflation. Okay. Done. So these are the various points that I wanted to discuss regarding inflation. Now, if you have any kind of a doubt, let me know, because questions are there, but I'll not start discussion right now regarding questions. We'll come back to the question after some time, because you're very fresh right now. I want to start with one more concept before look at the questions. But before that, any doubts that you have? What is IIP, my dear? We'll discuss IIP separately, right? Please have patience. There is a chapter called as industries. Under industries, I'll discuss IIP. Okay. Why is the base year for WPI 2011 and 12, CPI 2012? Argument is simple. Two different committees were set up. They found that the price data is much more stable for two different years. One calendar year and the other one is a financial year. It is based on the availability of data. Okay. What is base effect? Base effect simply means, have a look at this. I'm comparing. I'll ask you a very simple question. Right? Think of it and answer. You will compare the GDP value in 2020 with 2021. Simple question to all of you. Base year, don't bring in base year. Simple question, think of it. Don't you think what happened in 2020 will have an impact on what is the growth rate for 2021? I hope you understand my point here. What has happened in 2020, will it have an impact on the growth rate for 2021? For example, if you look at what is the growth rate for 2021, government will give you data such as 24%, 26%, which means compared to previous year, our economy is increased by 26%. But last year, your economy size was very, very small. I hope you understand the argument. Last year, your economic size, that is the value of goods and services that you had produced, had shrunk, had contracted because of the pandemic. Now, even if you produce a normal amount of production, because the production was very lesser here, you will feel that economy is increased by a very large percentage. But in reality, that would not have happened. That is basically the concept of base effect. That is, whenever you compare, right, inflation, you compare. GDP, you compare. IIP, you make a comparison. The same months of two different years. Same quarter of two consecutive years. Same consecutive two financial years. That because there is certain impact on the base, automatically will have an impact on the outcome. That is called as base effect. Okay? Done? Okay. Let me go to the next one. Why has the rupee depreciation taken place? Did I not tell you we'll have a discussion regarding rupee depreciation later? Right? I hope you understand. We'll have a discussion. I cannot get deviated and start discussing appreciation and depreciation of rupee. There is a separate chapter on it. Have patience. Okay. And many of you are asking, sir, 2000 rupee note, 2000 rupee note. Have patience, my dear. It means two things. One, you have not even have, you are so busy with UPSC preparation that you did not even have a chance to look at the video that we have already uploaded on 2000 rupee issue on our YouTube channel. And point number two, I'm discussing inflation. You're concerned about 2000 rupee note. I understand. I'm discussing inflation. I'm discussing taxation. You're worried about the 2000 rupee note. Everything is in its own place. We'll have a discussion. Have patience. When I discuss banking, I'll tell you. Have patience. When I discuss banking, I'll tell you why RBI has withdrawn the 2000 rupee note. I'll discuss that. Don't worry. Okay. Now we'll discuss regarding this. Questions have come in the prelims as well as mains from inflation, but later, not right now. Let me start with a new chapter now. Concept of fiscal policy, that is taxation. Now, if you remember earlier, we have discussed the term fiscal policy. I don't know how many of you remember this. We already have discussed the concept of fiscal policy. What is a fiscal policy? Fiscal policy refers to, I'll come back to the previous slide, don't worry. It refers to the usage of taxation and expenditure by the government to achieve certain objectives. Government wants to achieve certain objectives. For that purpose, government will use a taxation as well as government will use its expenditure. The set of policies collectively is referred to as fiscal policy. And under the fiscal policy today, we'll start with the concept of taxation. What all we'll be discussing? We'll start with the basics of taxation. We'll discuss types of taxation systems. We'll also discuss certain types of taxes. What are the problems with Indian taxation system? What are the reforms that the government of India has announced in the taxation system? And finally, the Laffer curve, and as usual, the questions in the UPSC prelims as well as mains from this chapter. Okay, let me start. What is a tax? If I were to ask you, what is a tax? Most of you will start giving me examples of tax. Many of you will simply say, sir, GST, sir, VAT, sir, income tax, etc. etc. Tax is nothing but it is a levy. Levy means charge. It is a compulsory levy or a charge that is imposed by the government. That is imposed by the government on individuals, companies, etc. I'll repeat the definition here. What do you mean by tax? Tax is a compulsory charge or a levy that is imposed and collected by the government. But it is imposed on whom? It is imposed on you and me. It is imposed on the government. It is imposed on the investors, etc., etc., etc. That term is called as a tax. And please remember this. The government is collecting tax, and in return for that tax, I repeat, the government is collecting tax, and in return for that tax, government will not give you any good or a service. Is the statement okay with you? Government, let's say, is collecting 100 rupee income tax from you. Can you tell government how they're supposed to use the 100 rupee? Right, for example, imagine the income tax official will come to you and they will collect a certain amount of taxes. Can you tell the official, sign here, saying that you will use the 100 rupee to construct a road in front of my house? Right, sign here and say that you are going to use that 100 rupee to fit, let's say, a street light in front of my home. Absolutely no. It is basically a one-sided payment. One-sided payment, that's it. Right, you will have to pay, I will have to pay, companies will have to pay, many others will have to make a payment without any exchange of goods and services for the tax being paid by us. That is basically the idea of a tax. Now, before I enter into the concept of taxation, very often you will come across the term tax base. Please remember this right now. What do you mean by tax base? Tax base is the object on which government will impose a tax. What do you mean by the tax base? Any object, anything on which government will impose a tax. Now, let me ask you a very simple question. Is this a part of a tax base? Think of it. Is it a part of the tax base? Anybody has a doubt here? Arey Baba, 4 of you are saying no. My dear, I don't want to take the names. But my dear, don't you think on this government has imposed GST? Think of it. On this government has imposed the GST. A tax has already been imposed. Is it a part of tax base? Yes. Is it a part of tax base? Answer is again yes. Right? It's a AC remote. It's a part of tax base. The salary, right? The salary earned by Mr. Mukesh Ambani. Is it a part of tax base? Yes. Salary earned by me. It is a part of tax base. Yes. So argument is simple. Tax base simply means any object on which government will impose a tax and collect the tax. That is called as a tax base. I have given you examples here. Income, wealth, asset. It should be crossed like this. Income, wealth or asset, etc. Right? All of these are examples of tax base. Right? Now remember the term, very often we'll use it in the discussion. Don't be confused. Now let me start. Before this, why does government impose a tax? What is the reason? Right? We have understood what is a tax. Later we'll discuss different types of taxes. Don't worry. Why does government impose a tax? First and the most important point, it is providing revenues to the government. It will provide lot of revenue to the government. And second, the revenue that is collected by the government will be used for incurring expenses. It will be used by the government for incurring various types of expenses. Understand the logic here. Here is the government. Here is the government. Government will impose a tax and collect the tax. And are there any other sources for the government to collect the money? Of course, yes. Government can sell Air India and get the money. All of you will agree with me? Let me know. Government can sell Air India and collect the money. That is selling assets. There is a term for this, disinvestment. Don't worry. Don't get deviated. Focus on the discussion here. The government can sell the assets that they own and get the money. But there's a problem. What is the problem? Do you think this model is sustainable? Think of it. Do you think this model is sustainable? That is, do you think always government will have sufficient number of companies that they'll be able to sell and raise money? Of course, no. One, government will have a limited number of assets. And second, government might have assets. What is the guarantee there are buyers for it in the market? What is the guarantee that there are buyers for it in the market? There should be buyers also, no? Right? So one more method is they can sell the assets and raise money, but there's a problem with this. And the third one is government can simply borrow. Government can simply borrow. Now later we'll discuss how government will borrow, what kind of borrowings are done, what are the problems, etc., etc. We'll discuss it in detail. Please don't worry. But don't you think when government will borrow, government has to repay along with interest? Okay. Government will have to repay along with interest. So this is also not, right? This is also not a sustainable model. Again, comparatively, I'm making a comparison here. I'm making simply a comparison. Government of India will end up borrowing every year. Why is that so? We'll understand it later. But between taxation and borrowing, which one would you prefer? As a government, you will simply say, sir, tax source is always better. Tax source is always better. In fact, there are many other sources. For example, government will own a company, right? Let me check how many of you have read the newspapers. RBI very recently has announced a lot of surplus or dividend to government of India. How many of you read this right article in the newspaper? And I'll tell you, when I discuss RBI, I'll tell you what is dividend, etc., etc. Have patience. But it was there in the newspaper. So there are different sources. But please understand, when you look at through what sources government will collect money, more than 60% of total money collected by the government. I repeat, more than 60% of total money collected by the government is in the form of taxes. It is in the form of taxes. That is the importance of taxation for the government. And is it okay if I say, if the tax collection will go down, government will have to borrow more money? Think of it. If the tax receipts, that is the money through taxation, will go down, then government doesn't have any option but to start borrowing more and more. That is a problem. Right? Borrowing anyways is a problem. Government borrows. But don't you think more and more borrowings of the government always is a problem? Right? Later we'll understand how much borrowings they do, what are the problems, how much interest they are paying, etc., etc. So that is the importance of having a taxation policy, for the government. Okay, now let me enter into the main discussion here. Types of taxation systems. We'll have a discussion one by one. Follow the discussion very carefully. One is direct and indirect taxes. Let me start with the example. Direct taxes, right? Examples are income tax, corporate tax. And when I say income tax, I'm talking about income tax on individuals, such as you and me. Income tax on individuals. Because income tax for a company is called as a corporate tax, property tax, etc. These are direct taxes. What about indirect taxes? Value added tax. VAT stands for value added tax. We'll discuss it later. Have patience always. value added tax, excise tax, GST, that is goods and services tax. These are the best examples of indirect taxes. Now let me explain what is the basic difference between a direct tax and an indirect tax. Whenever government will impose a tax, government imposes a tax and this tax is transferred to the consumer. This is transferred to a buyer or consumer. Buyer or consumer. Right? Best example, government will impose a tax on a company. And what does the company do? Company will transfer the tax to you. Let me give a very simple example. Your friend is back. Imagine I'm a manufacturer, I'm the shopkeeper, I'm selling this bottle to you. Government will impose the GST on me. I'll repeat. Government will impose the GST on me. Let's say 100 rupees is the actual cost of the bottle. GST is a 10%. That would be how much? 10 rupees. But what I will do is, when you will come to the shop to purchase the bottle, I will not only collect 100 rupees, which is my actual cost, I will also collect 10 rupees from you, transfer this 10 rupee to the government. Transfer this 10 rupee to the government of India. Can I simply say in this example what has happened is, the taxes or the burden of taxes are getting transferred. Any problem in understanding this? The burden of taxation is getting transferred. Anybody is having a problem? Let me know right now. The burden of taxation is getting transferred. The government is imposing a tax of 10% on me. I am not paying the 10%. You will come to the shop, you are the buyer or a consumer. I will sell the bottle to you. I'll collect the 10% tax from you, transfer it to government. In such cases, wherever the burden of taxation, gets transferred, these are called as indirect taxes. In such cases, whenever the burden of taxation, the taxes can be transferred like this, that is called as, the indirect taxes. Can I go to the direct taxes here? Any problem here? Can I go to the direct taxes? I can't understand. My dear, how difficult is it? How difficult is it? You will come to the shop. Government has told me to pay GST. I'm the shopkeeper. Government has told me to pay GST. Will I pay that GST out of my pocket? No. You will come to me, purchase the bottle. I will collect the GST from you. You're the buyer, and give it to the government. So government has imposed a GST on me, but I'm transferring it to you. Wherever the tax burden can be transferred, that is indirect tax. Right? Can I give you one more example? You must have been to watch a movie. You must have gone to, let's say, INOX, PVR INOX, or let's say any movie theater. Right? There's a tax, GST, on such movies. But the tax is imposed on the INOX company. What they will do is they will transfer it to you when you purchase a ticket. Have you not purchased anything in the market in the last 1 year? If you have purchased, please look at the receipt. There is a GST. GST is the prime example of an indirect tax. Okay? Right? So one is indirect tax. What about the direct tax? Direct tax, have a look at this very carefully. In direct taxes, the burden of taxation cannot be transferred. The tax burden cannot be transferred. What do you mean by tax burden here? Imagine I'm earning, let's say, 10 lakh rupees as my annual income. Government will impose a tax and collect, let's say, hypothetically, 1 lakh rupees in the form of income tax. Hypothetically, by the way. So 10 lakh rupees is my income. Government will tell me, please pay up 1 lakh rupees. Now, can I transfer this burden of 1 lakh rupees to somebody else? Absolutely no. Government has imposed the tax on me. I will have to pay the 1 lakh rupees to the government. So whenever the tax burden cannot be transferred, tax burden means ultimately who will pay the money. Ultimately, who will end up paying this amount of money, that is called as a tax burden. So in the first example, the tax burden falls on whom? The buyer or the consumer. All the government is imposing on the company, the burden is falling on the buyer or consumer. In the second example, the tax burden will fall on the income earner. The government is imposing a tax on the person who is earning income, and it is the same person who will end up paying the income taxes to government. What about property taxes? What are property taxes? A person will own the house, and it is the same person who will have to pay property taxes to the government. The same idea is direct taxes. Any problem here? Can I go to the next one? Can I go to the next concept? Direct taxes and indirect taxes. Now let me add one more point here. Which one do you think is better for government to collect more and more tax revenue? I'll repeat, between direct taxes and indirect taxes, which one would you prefer to collect more and more money? Should it be indirect taxes or should it be direct taxes? What does your mind say? Think of it. My dear, most of you are saying indirect taxes, you are wrong. Government should be able to collect more and more taxes through direct taxes. More and more money should be collected by the government through direct taxes, not indirect taxes. Right? And I'll tell you the argument. Government will impose, let's say 20% GST on this. Government will impose 30% GST on it. So government will be able to collect more money. But what if this is an essential commodity? Point number one. What if it is essential commodity? That is, everybody will purchase this bottle. In that case, don't you think you are imposing more and more tax on poor people? Think of it. Don't you think in such cases, you are imposing more and more taxes on the poor people? Rich people will pay taxes. I hope you understand my point here. Whether it is 30%, 40%, 50%, rich people anyways will pay the taxes. But don't you think you in order to collect more amount of money, you have increased the indirect tax on this, it will have a negative effect on the people who are, right, let's say very, very poor. Point number one. Point number two, can I simply say that direct taxes, whenever they're imposed and collected, the taxpayer can be identified. I'll repeat the statement here. The direct taxes, whenever they are imposed and collected, government can target the taxpayer. Whereas in indirect taxes, government cannot target the taxpayer. These are universal in nature. Sir, what do you mean by this? Let me start with the point number one. How do you say direct taxes can be used for targeting? Government wants to collect more amount of taxes. Government will simply say, anybody who is earning more than 1 crore rupees, they will have to pay more income taxes now. Simple idea. Let me know whether this is feasible, correct or not. Government wants to collect more amount of taxes. So what government will say? Those people who are earning more than 1 crore rupees, now you pay more income taxes to me. Last year you paid 20%. I will increase it to 25%. Last year you paid 25%, right? I will increase it to 30%. Do you think these taxes will affect poor people? Is it okay? Do you think these taxes, right, the example that I told you just now, will affect a common man, poor people? No. Those who are rich, they are paying more taxes. Right? Those people who already are earning huge amount of money, they are paying more taxes. But on the other hand, what if Government of India will identify certain goods such as rice, such as pulses, cooking oil, etc., and government will simply say GST is increased from 10% to, let's say, 18%. Again, just hypothetical calculation, don't buy heart everything here. GST is increased from 10% to 18%. Now tell me, will government taxes increase? Of course, yes. The government will be able to collect more taxes. But don't you think it will affect the poor people much, much higher compared to rich people? Is it okay? Right? It will have a negative impact, huge amount of a negative impact on the poor people compared to rich people. That is the reason I said, whenever you target or whenever you have these taxes, the government should collect more taxes under direct heading rather than indirect taxes heading. Okay? Right? So this is basically the idea of a direct taxes as well as indirect taxes. Any difficulty here? Any difficulty here? Let me know. Shall I go to the next one? Okay. Next system. Property taxes can be transferred to another. How? Show me the agreement. Right? One person says property taxes can be transferred to another person. Right? If I own the house and give the house to rent and ultimately the tenant pays the tax. Who says that? Right? Have you resided in a right? Let's say have you taken any house on a let's say rent basis? If yes, please check the agreement. Please check the agreement. It is the owner who pays the property taxes, not the tenant who pays the property taxes. At least that is how the agreements are made. If you are basically saying that, if you have the agreement, show it to me. Okay? No, that is not generally the situation. Okay, let's start. Next one is progressive, regressive, and proportional. Progressive, regressive, and proportional. Okay? Now, what is progressive? What is regressive? What is proportional? Let's go one by one. Again, don't try to complicate the subject. Many of you are trying to complicate it. Sir, what about electricity bill? Right? He will transfer it in the form of water bill. Arey Baba, don't complicate it. Government says it's a direct tax. Agree and go forward. Right? Do not complicate it. Progressive, regressive, and proportional. Let's start. What do you mean by progressive? As the income increases, the tax rate collected or tax rate imposed and taxes collected will also increase. Any problem in this? I'll repeat it. Progressive, as the income increases or as the tax base increases, the taxes imposed by the government will also increase, right? That is called as a progressive taxation system. Example for this is income tax. Example for this is income tax. Right? For example, if you have an income of let's say 5 lakh rupees, if you have an income of 5 lakh rupees, let's say income tax rate is 5%. Right? Let's say income tax rate is 5%. And if your income is 5 lakh to 10 lakh rupees, your income tax rate will become 20%. Now, please look at this and tell me, is it progressive or not? Right? Please look at the picture and let me know, or the numbers and let me know, is it progressive or not? That is, as the tax base widens, tax base increases, the taxes imposed by the government will also increase and the tax collection will also increase. That is progressive taxation system. The direct taxes, specifically income taxes in India. Income taxes in India are progressive in nature. Let me go to the next one. Regressive taxation system. The tax rate decreases with the income. The tax rate will keep on decreasing with the income. And the example in case of India, again, this is where the technicality is required. I don't want you to enter into technical concepts, but understand this carefully. Indirect taxes generally are regressive in nature. Indirect taxes are generally regressive in nature. For example, in case of India, the indirect taxes that we discuss, such as GST, such as VAT, etc., these are regressive in nature. Right? That is basically the concept of regressive taxation system. Any problem with regressive? Can I go to the next one here? Any problem with regressive? Shall I go to the next one? Explain. My dear, you don't require it. That's the reason I generally discourage students from asking all these kind of questions. In that case, you will have to enter into optional papers. You'll have to enter into optional papers. Why? In case of regressive taxation system, you need to understand the concept of average rate and marginal rate. Average rate and marginal rate. Now, don't check any book, you will not get it. Right? Understand the logic here. And if you ask me, not required for UPSC. As far as I'm concerned, not at all needed for UPSC. What do you mean by average rate? How much is your average rate of tax? How much is average rate of tax? And marginal rate is with increase in the income by 1 rupee, how much tax rate is applicable? Now you will start running behind marginal rate and average rate, although these are not at all needed, right, for prelims or even for GS paper. Whenever you talk about a regressive nature, you will have to calculate what is the average rate, average tax rate, and whatever is the marginal tax rate. And right, in such situations, what you generally see is the marginal tax rate. I repeat, the marginal tax rate, and when it is compared with average tax rate, in case of progressive and regressive, these are opposite. These are simply opposite. Meaning what? In case of progressive, the average tax rate and marginal tax rate, if you compare this, what you will realize is the marginal tax rate is greater than average tax rate. This is in case of progressive. So how do I prove it? Take this and calculate, you will understand it. Whereas in case of regressive taxation structure, the marginal tax rate, it is smaller than average tax rate. How do you prove it? Now for that reason, you'll have to take a product, let's say a product. What is the tax rate on this? How much is income of, let's say, two people, A and B? One is a crorepati, one is, let's say, a very, very poor person, etc., etc. That's the reason, do not enter into all of it. If you ask me, even this is not at all needed for UPSC. Even this is not needed for GS paper. Whenever you enter into optional papers, there are a lot of calculations which are required in the optional papers. That is where we calculate what is the average tax rate, what is the marginal tax rate, make a comparison, and then decide, right, what is progressive, what is regressive. In case of progressive, average tax rate is smaller than marginal tax rate. Whereas in case of regressive, average tax rate is greater than marginal tax rate. More than sufficient. Otherwise, in a simple way to understand, imagine the bottle will cost you 100 plus 10 rupee. The 10 rupee is a tax. Now, you will pay, right, let's say 110, which means you have paid 10 rupee tax. Your income is 1000 rupees. And Mr. Mukesh Ambani, right? Mr. Mukesh Ambani will come and purchase the same bottle and pay 10 rupee tax, but his annual income is 30 crore rupees. Now tell me, between two of them, on whom the tax burden is high? Let me know. Right? Don't enter into technicalities. That's the reason I generally say don't enter into technicalities. Right? You want to become expert in economics, not at all needed. It's never needed. I'm giving a very, very simple example. Right? You have an income of 1000 rupee and you will pay a GST of 10 rupee. Mr. Mukesh Ambani has an income of 30 crore rupees. Right? He will pay 10 rupee. On whom the tax burden is very high? On you. That is the first person. Is it not an indirect tax? As the person is earning more income, the tax burden on the person is actually going down. Is it okay? As the person is earning more and more income, tax base is increasing, but the tax burden is going down. Right? That is basically the idea of a regressive taxation structure. Okay. And finally, proportional taxation structure. In proportional, there is absolutely no change in the rate of a tax, whatever the income base, or let's say the tax base be. Whatever is the tax base. Is it 10 crore? Is it 20 crore? Is it 100 rupees? Is it 1000 crore? Uniformly, let's say the tax rate is 10%. Then this is called as a proportional taxation system. Right? So one is progressive, second one is regressive, third one is a proportional taxation system. In progressive, as the tax base increases, the tax rate, taxes collected and imposed will also increase. In regressive, as the tax base will go down, and right, basically the tax rate will increase and vice versa. And finally, the proportional, whatever be the tax base, right, the tax rate will remain same, one and the same. That is called as a proportional. For example, in case of India, Government of India imposes taxes on the profits earned by the companies, and right now different rates are there. One of the rates is 22%. Right, one of the rates is simply 22%, which means whether you are earning an income or let's say profit of 100 crore, 200 crore, 500 crore, etc., doesn't matter, you will have to pay 22% taxes. That is called as proportional example of a taxation. Okay, right? So progressive, regressive, and proportional. And again, I'm repeating this again. Some of you worried about regressive. Trust me, I can enter into technicalities. My optional is economics, my dear, by the way. Right? I can enter into technicalities. I can take a long table, discuss what is average rate, what is marginal rate. How do we say in indirect taxes, marginal rate is a marginal rate of taxation is right lesser than the average rate. We can discuss it, but it is not at all needed for you. Simply look at the definition and go forward. And if you don't trust me, please look at the books that you're referring to. Every book would have given simply this definition. Okay, right? So that is basically the idea of a progressive, regressive, and proportional. Okay. Example of proportional: corporate taxes. Corporate taxes. Right? Please understand. Right? Again, I don't understand when I tell you an example. Please take it and move forward. Right now, corporate taxes, there are three types in India. 15%. Some companies which will start manufacturing by 2024, they have an option of paying corporate taxation of 15%. Another is 22%. Some of the companies, they have the option of paying 22% corporate taxes. And some companies have the option of paying 30% corporate tax. Again, I'm saying option. Option is there to you. You want to use a 22%, you want to use 30%. And again, some of you will start typing, sir, if 22% is there, why would I require 30%? Why will I pay 30%, etc., etc.? I'll explain that. Have patience first. Imagine if some of the companies have chosen 22%. Company A will make a profit of 100 crore. Company B will make a profit of 200 crore. Company C will make a profit of 300 crore rupees. Now, please tell me, though the profit is changing, right, what is the tax rate applicable to all of them? What is the tax rate applicable to all of them? Same rate? Can I call this as a proportional taxation? That is irrespective of the tax base. Irrespective of the tax base, same tax rate is applicable to all of you. That is basically the idea of a proportional taxation. Okay, done. Now this is the discussion regarding progressive, regressive, and proportional. Now let me take a break. Right before break, anybody has a doubt, let me address your doubts first, and after that we'll take the break. Good effects of inflation. Good effects of inflation. I stated that whenever you talk about inflation, inflation is needed because it represents a higher demand in the market. It represents a growth rate in the economy, and rather than increasing, which represents inflation, if the prices will start decreasing, then the demand automatically will go down. That could lead to negative outcomes in the economy. During inflation, which one impacts more, imports or exports? You tell me. Don't you think rather than exporting, your imports will become cheaper? Right? Imports will become cheaper, exports will become less competitive. Okay. Why we target inflation at 4%? right? The question is again, why not 4%? Let me ask you this question. So why 4% only? My dear, I told you, no, healthy rate of inflation. You cannot keep it at 8%. 8% is very high. You cannot keep it at the same point of time 1%. So there is a compromise which has been made. We have decided, okay, 4% is needed in the economy. Okay. Wouldn't government expenditure reduction mean lesser subsidies, which would increase factor cost, which could lessen supply and thereby increase prices further? How? Wouldn't government expenditure reduction mean lesser subsidies? Not always. Not always. Right? Government might simply reduce other expenditures, keep the same subsidies. There's no guarantee in what way government will reduce expenditure in which area. Okay. Why do we not simply subtract the inflation rate from year on year GDP growth rate? Why are you comparing two different numbers? My question to you people is, why are you comparing two different rates? One is basically talking about inflation, which represents market prices of, let's say, identified goods and services. And the other is GDP growth rate, which represents the whole market price of all the goods and services. Right? The basket is completely different. If the price of the same commodity increases more than the price of that commodity from base year, that is inflation. Price of the commodity increases compared to base year, that is inflation. Okay. What if nominal and real prices remain same and just the value of goods are different, still we can still manage to get GDP deflator as 1.5? How? Again, I don't know why generally students try to complicate everything. Sir, what will happen in that? What will happen in this? Don't complicate it. Keep it simple. No. If nominal and real prices remain same, if nominal and real prices are same, then what is the difference? Inflation is not there. If inflation is not there, what is the GDP deflator then? Have you understand that? Okay. Explain investment scenario once more. If inflation rate is higher, rather than investing in, let's say, fixed deposit, you will basically invest in other assets such as, let's say, gold, and that will reduce, right, let's say, movement of deposits in the bank, and that will have an impact on capital formation. Explain why government increased expenditure despite inflation. Inflation was higher, government increased investment to promote recovery in order to have counter cyclical fiscal policy. Okay. Okay. So let's take a break now. Let's take a break. I'll restart at 7:20. I'll restart at 7:20 p.m. Okay, take a break. I'll restart at 7:20. Okay, welcome back. Am I audible? Can we start? Am I audible? Shall we start? Okay, done. Let's start. So next type, ad valorem and specific tag. Ad valorem and specific tags. Progressive and regressive second point. Again, when you say progressive and regressive second point, what? But progressive tax, it depends on the people to pay taxes. Right? For example, if your income is 1 lakh rupees, income is 10 lakh rupees. If your income is 20 lakh, don't you think with more income, you have more capacity to pay? That is exactly the same point. Okay, next one, ad valorem and specific tax. Let's start. Now, what is ad valorem? What is specific tax? Ad valorem tax is a tax that is imposed on the value of the product. What do you mean by value? In terms of money, what is the value of the product? For example, you're a manufacturer, your bottle is back, you have manufactured this bottle, you want to sell it at 100 rupee in the market. Let me know. Can I say this 100 rupees the value of the product? Is it okay? You have manufactured the bottle, you want to sell the bottle at 100 rupees in the market. Can I say 100 rupees the value, monetary value of the bottle or not? So when the government will impose a tax, it will impose the tax on the value of the bottle. For example, let's say government will impose 10% tax on this. Government will impose a 10%, 12%. Now, simple question to all of you. If I say 10% or 12%, is it not calculated on this value itself? Can I go to the next point? Is it not calculated on the value of the product? Right? Of course, the answer is yes. You should not have any doubt here. Right? For example, if you go to market and try to purchase it, they'll say GST rate is 18%. Now tell me, my dear, when they say 18% is the GST rate, it is 18% of what? 18% of your salary? 18% of Mr. Ambani's salary? Absolutely no. Value of the good, value of the service. So whenever you impose a tax on the value of a product, that tax is called as ad valorem tax. It is referred to as ad valorem tax. Best example for this is value added taxation, excise duties, even for that matter GST, etc. Let me go to the next one. Specific tax. Specific tax. Now understand the difference here. Understand the difference. You have manufactured the bottle. Government says per bottle. I repeat. Government says per bottle tax will be 10 rupees. Is the logic okay? Can you understand the difference between the first one and the second one? I'll repeat it again. You have manufactured the same bottle. Second one I'm talking about. That is a specific type of a tax. Government says per bottle tax will be 10 rupees. That is basically the concept of specific tax. Specific tax are those taxes which are imposed on physical attributes of a product such as quantity, such as volume, height, length, etc. Can I give you examples for this? Right? Let me know. In case of India, I'm saying cars are taxed based on the length of the car. In case of India, the cars, right? Some of the cars are imposed, the taxes on them, it is imposed on length of the car. Is it not a kind of a specific tax here? Is it okay? Is it not basically a type of specific tax? Can I give you one more example? When you go to a petrol bunk, this is very important, understand the idea here. When you go to a petrol bunk and you want to purchase 1 liter of petrol, central government, I repeat, central government will impose a tax on per liter. It will impose a tax on per liter of fuel. What is the meaning of it? Let's say actual price of the fuel is 80 rupees. Government will impose a 10 rupee per liter. 10 rupee per liter in the form of a tax. Which also means, understand the logic here. Please understand the logic here. What if the price of the fuel becomes 90 rupees? Let me check. First case is, let me check how your mind understands all of this. Tax is 10 rupee per liter. Okay. What will be the MRP? 90 rupees. Second case, the price of the fuel, petrol goes up. Tell me what will be the market price. Tell me what will the market price. Government is not changing taxes. Same 90 plus 10 rupees per liter, 100 rupees. Any problem with this? Some of you are saying taxes will increase. My dear, please understand. That's the reason I tell you people focus on the discussion. Focus. I'm saying 10 rupees per liter. Whatever be the market price, whatever be, right, that is except the government taxes, whatever be the prices here, don't you think this tax will remain same? Don't you think the tax will remain same here? What if the price will fall down to, let's say, 60? Then the market price, assuming government of India, I repeat, government of India does not change the tax, then the market price will become 70 rupees. Any difficulty in understanding this? Both are different. Ad valorem is different and specific taxes are different. Specific taxes are imposed not on the value. I repeat, not on the value of the product. It is imposed based on the quantity, based on length, based on height, based on liters, etc. On the other side, let's take the same example. Right? Let's say GST. Price of the bottle, you decided 100. And if the tax rate is 10%, you tell me 10% of 100, right now it will be how much? 10 rupee. What if because of cost of raw materials, etc., the price will increase from 100 rupees to 120 rupees. Now 10% of 12 rupee, that will become 12 rupee. Sorry, 10% of 120 will become, right, 12 rupee. Or some of you are saying 130. How, my dear? 10%, no? 10%. So this is basically the example of ad valorem. This is example of ad valorem. This is example of specific taxes. Remember the next point very carefully. Remember the next point very carefully. In case of India, on fuels, this is important current affairs. In case of India, on fuels such as petrol and diesel, day-to-day consumption, central government will impose taxes per liter. Central government will impose the taxes per liter, specific tax. Whereas the state governments generally impose, because it is from one state to another state government. State government will impose ad valorem. Okay, state government will impose ad valorem. Any difficulty in understanding this? By the way, what I'm trying to tell you is another point. When you purchase a liter fuel, be it petrol or diesel, central government also has implemented a tax on this. State government also has implemented tax on this. Only difference is central government imposes per unit tax, that is per liter tax. State government imposes ad valorem, that is based on the value, price of the product. Now let me ask you a very simple question. I'll answer this by the way, but just try to think of it. Between the ad valorem and the specific tax, which of the two do you think will give more freedom for the government to collect taxes without harming customers? I'll repeat the statement. I will repeat the statement here again. Between the ad valorem and the specific, and think of it. Please think of it. Between specific and ad valorem, which of the two do you think will give more freedom to the government to collect taxes without harming the buyers or customers? Think of it. Let's see. The right answer is ad valorem. The right answer is ad valorem. Some of you are saying specific, right? Slightly tricky. Question is slightly tricky. I know that. Right answer is ad valorem. Let me explain it. Imagine the price of the fuel is 90. Without central government tax, imagine price of the fuel is 90. And the government has decided fixed. I'm going to get 10 rupee tax per liter. fixed. I'm not going to change it. It's specific tax. What is the market price? 100 rupees. If, right, the price of the fuel goes up to 100, government will again say fixed 10 rupee. What is the price of per liter fuel? 110. If it further increases to 110, central government says fixed 10 rupee. What is the market price of the product? 120 rupees. But think of ad valorem here. Instead of specific, what if they had used ad valorem tax? Here government is earning how much tax? I have to understand. Government is earning how much tax? 10 rupee. Imagine government to begin with had a tax of 10%. Ad valorem, 10%. Let's say price of the fuel is 100. Price of the fuel is 100. Government will impose 10% tax on it. Government will earn how much? 10 rupee. Right? So market price will be 110. Now the price will become 110. Price will become 110. Government wants to earn 10 rupee. I hope you understand. Government wants to earn 10 rupee. Can they ensure that they will earn a 10 rupee by reducing the tax rate to, let's say, 9%? Is it okay? Can they ensure that, can the government ensure that they will reduce the tax rate from 10% to 9%? Because basically they are focused on tax collection. They want to earn 10 rupee. So what they can do is they can reduce the tax rate from 10% to 9%, ensure, right, it is 110, so obviously 9 rupee 90 paisa, right? So ensure that it will be 119 rupees 90 paisa, which means understand the logic here. Please understand the logic. Here they can adjust the tax rates. Here they can adjust the tax rate, still keep on earning the same amount of taxes. Flexibility. I'm talking about flexibility. Here the government can adjust the tax rates, still keep on earning the same amount of tax rates. In this case, is there a flexibility for the government? Tell me, in the first case, is there a flexibility? Now, many of you simply say, but sir, they are earning same thing, market price is same thing. Now think of it and tell me, government will announce, looking at the higher crude oil prices in the international market, I will reduce my tax from 10% to 9%. Don't you think? Government is still earning the same amount of income without having to forego any part of their income. Think of it. Just understand the logic behind it. And my question was very simple. I said, which of the two do you think will provide flexibility for the government to collect taxes without affecting the customers? Right? In this case, government will simply tell you, please see the international prices, they have increased. I do not want to keep the same percentage. I will reduce it to 9%. You will become very happy. You will simply say, see, government is working for me. Again, don't write all of this. I hope you understand. Do not write all of this in the paper. You will become very happy. See, with the rise in the international price of the fuel in the international market, government has reduced the tax rate. But little do you know that even with the lower tax rate, they'll still keep on earning the same amount of tax revenue. I understand that kind of flexibility is there with the government. And some of you will simply say, sir, we can reduce here also. My dear, if you reduce here, the tax revenue will automatically go down. Tax revenue of the government automatically will go down. Are they going down here? Are they going down in case of ad valorem? No, they will ensure that they will still earn the same amount of revenue, but they will tell you, we have reduced the tax rate. Right? That is how taxation policies are used. Is it okay? Right? That is how the taxation policies are generally used. But again, please understand, central government imposes per unit specific tax on the fuel, and second, state government imposes ad valorem taxes on fuels. Okay, so this is ad valorem and specific. Right? Let me go to the next one here. Next concept, surcharge and cesses. Surcharges and cesses. Now, what do you mean by a surcharge? What do you mean by a cess? Both are types of taxes or charges. Now, surcharge, basically a concept of tax on a tax, wherein government, I repeat, government will impose a tax whenever the tax base will cross a certain threshold. I'll repeat the statement here. What is the basic idea? Surcharge is a type of a tax or a levy that is imposed by the government whenever the tax base will cross a certain threshold. Now, what is the basic idea of a tax base here? Let's take an example. Incomes. Incomes earned by the people. Now, let me ask you a very simple question. A is earning, let's say, 1 lakh rupees. B is earning 10 lakh rupees. And C is earning, let's say, 1 crore rupees. And D is earning 5 crore rupees. Okay, A 1 lakh, B 10 lakh, C 1 crore, D 5 crore. Now, A will not pay any tax. No tax is paid in case of India by A because the income is below 2.5 lakh rupees. B will have to pay certain income taxes, right? I'll just take arbitrary numbers. I repeat, I'll take arbitrary numbers. In taxation, do not become a chartered accountant. This is my sincere advice to all of you. Do not become a chartered accountant. Understand the logic behind it. Let's imagine B will have to pay 10% taxes. C will have to pay, right, 20% taxes. And D will have to pay 30%. Again, these are hypothetical numbers. I know some of you are from economics background. Some of you are paying income taxes. I know you will jump over me and say, sir, you're wrong here, you're wrong here. I'm not taking what is used in India. I'm just giving you hypothetical example. Now tell me, C is paying more tax compared to B. D is paying more tax compared to C. Is it progressive in nature? Let me know. Is it progressive in nature or not? Answer is yes, by the way. Can we make it much more progressive? Can we make it much more progressive? Answer is again yes. How? How can we make it much more progressive? Government will simply say, anybody who is earning 1 crore rupees and above, that's a threshold. Threshold means a limit. Anybody who is earning 1 crore and above, let's say up to 5 crore, in addition to the income taxes, will have to pay 10% surcharge. I will tell you how they will calculate. Not needed, but I'll tell you. Now, government will also say, anybody who is earning income of more than 5 crore rupees, in addition to income taxes of 30%, they will have to pay 20% surcharge. Now, is it okay if I say, by imposing surcharges, additional taxes, this system has been made much more progressive? Let me know. By adding surcharges to the system, right, in this case, this is already a progressive system. We have made the progressive taxation system much more progressive. That is the basic idea of a surcharge. That is basically the concept of surcharge. Surcharges are imposed generally in addition to whatever taxes you are paying. Right? Whatever taxes you are paying, in addition to that, you will have to pay more taxes. Now, some of you are saying, so 30% plus 20%, it is 50%. My dear, listen to the statement that I'm giving. It's like some of you will read 50% plus 49% in front of a showroom. Discount board, 50% plus 49%, you will start running into the showroom assuming it is 50 plus 40. Simple calculation, 99%. Absolutely no. Absolutely no. That is not how the calculation is done here. And same thing, that is not how the calculation is done here. I'll tell you how the surcharges are imposed and collected. Do not by heart it. UPSC will not ask you. Let's say this person C, whose income is 1 crore rupees, 20% income tax he is supposed to pay. And I'll throw another arbitrary number here. Don't calculate, not useful for you. Let's say this person C is paying 15 lakh rupees. let's say this person C is actually paying an income tax of 15 lakh rupees. Now government will collect this 15 lakh. In addition to 15 lakh, they will also calculate 10% of the income tax. Is it okay? In addition to 15 lakh, that's the income tax. They will also collect 10% of 15 lakh. That would be 1.5 lakh rupees. So the person will not only pay 15 lakh income tax, the person will also pay surcharge of 1.5 lakh. Right? Same logic related to, right, the D also. Right? Same logic related to D. Right? Whatever tax the D will pay, that is income tax, government will calculate 20% of the income tax and collect it from the taxpayer. That is how the taxes are imposed. And in addition to taxes, surcharges are imposed and collected by the government. And the logic is very simple here. Why does government do this? Government says, I want to make certain people pay more taxes. I hope you understand, right? The argument is very simple by the government, right? In fact, in case of taxation, again, more of related to, let's say, optional paper, there's a concept called as canons of taxation. And one of the principles related to taxation is the person who has more capacity to pay taxes. I hope you understand this. The person who has more capacity to pay taxes should be paying more taxes. In this case, is it okay if I say compared to A and B, C has more capability to pay more taxes? D has a more capability to pay more taxes. That is what the government of India is doing. So whenever the surcharges are spoken of, the logic is very simple. It's a tax that is imposed by the government. Okay, the tax that is imposed by the government whenever the tax base will cross a certain threshold. That is basically idea of a surcharge. And imposition and collection of surcharges will make the whole system much more progressive in nature. Okay, that is surcharge. There is one more point here. I'll come to this. Just give me some time. Next, cesses. Next one is cesses. Cess is a tax that is imposed. Cess is a tax or, right, basically a surcharge that, a charge that is imposed by the government on a given, right, government on a tax for a specific purposes. For specific purposes. Please understand the difference between 1 and 2 here. Do not say both are one and the same. Please know. Surcharges government will simply impose, collect and keep it. Use it for any purpose. Whereas cess, right, it is imposed by the government. That is a tax that is imposed by the government. Money is collected, can be used only for specific purposes. Meaning what? Let me give a very simple example. Earlier, not today, government had a cess by the name of Krishi Kalyana Cess. Have a look at this. Krishi Kalyana Cess. Now tell me, based on this itself, you tell me, whatever cess was collected by the government, can they use it to construct a bridge? Think of it and let me know. Can they use this cess amount to construct an airport? Some of you are saying yes. My dear, then you are not even listening to what I am discussing. The beauty of the discussion is I've given you a statement, specific purpose, and the name is Krishi Kalyana Cess. And your argument is, sir, they can use it to construct airport. How, my dear? What is the name of the cess? Krishi Kalyana. Krishi Kalyana means development of agriculture. And your argument is they can use the money for development of port. How? For development of agriculture. Let me ask you one more. Even today, there is a cess by the name of healthcare cess. There is a cess by the name of healthcare cess. Can this be used to provide farmers subsidies? Right? Logic is simple, by the way. Do not complicate it. Right? Don't you think whatever healthcare cess is collected by the government has to be used only for providing healthcare services? What about education cess? What about education cess? In fact, the combination is simple. Healthcare, higher education cess. So education says, can we use it to construct, let's say, national highways? Can we use it to construct, let's say, airports? What is the connection to education in India? So whatever cess is collected has to be used only for education purposes. Is the logic okay? Any problem in understanding the difference between a surcharge and cess? Let me know right now. Any problem here? In case of surcharge, government will impose it, collect it, use it for whatever purpose they want. Whereas in case of cess, government, when they announce it, they will clearly tell you for what purpose they are collecting. And right, whatever money they have collected, they will have to use it only for the specific purposes. They cannot use it for anything else. Now have a look at this. Right, have a look at the next point. Some of the cesses are imposed as a percentage of the tax, and in some cases it is imposed on value. It should not be very difficult. Right, imagine, I'll give you both of the examples respectively. Follow this. Bottle, price is 100 rupee. Government will impose a cess of 4% of value of the bottle. First example. Second example, bottle plus 5 rupees cess imposed by the government. So cesses in many cases are imposed as a value, percentage value of the product, and in many cases are imposed simply as right, exact values, that is exact money, right, that is imposed and collected by the government. Now third point right here and third point here. The revenues earned by the center through this, etc., etc. Let me explain this. Follow this very carefully. Let me explain. For those of whom, for whom the polity is over, it becomes a repetition. Those who are listening to this for the first time, understand it very carefully. All of you know there is a 7th schedule in the Constitution of India. There is a schedule in the Constitution, 7th schedule under the Constitution of India. And this 7th schedule basically discusses what? Distribution of powers. Distribution of powers between center and state. Okay, distribution of powers between center and state. And one such power is taxation power. One of the powers is taxation power. And many of you who have attended the polity are saying absolutely right. So union list, state list, and concurrent list. And those who have heard the term union list for the first time, do not worry, it will be covered in polity. I'm economics faculty. What is required, I'll tell you now. One of them is taxation power. And most important taxes, I repeat, most important taxes. And when I say most important taxes, whenever you talk about taxes which can be imposed throughout India, these are given to the central government. These are given to central government. Can I give you one example? Let me know. Personal income taxes. Personal income taxes. Corporate income taxes. Can they be implemented throughout India or not? Is the logic okay? Can they be implemented throughout India or not? Of course, yes. Excise duties on imports, exports. Lot of these important taxation powers are given to center. Now, when the center has the power to impose and collect the taxes, can we allow only the central government to use all the tax money? I'll repeat the statement. Central government has been given the power to impose and collect these important taxes. Can we allow only the center to use this money? No. What about the states? Some of us are saying yes. No, we should not allow that, by the way. What about the states? From where do the state governments will get the money from then? That is the precise reason. What we have is the concept of right devolution, tax devolution, tax distribution. That is, understand this very carefully. Central government will impose and collect all these taxes, and these taxes which are collected is called as divisible pool. This is called as divisible pool. Any difficulty? Central government has imposed and collected these taxes, and this is called as what? Divisible pool. From the divisible pool, now we will have to give some of these to the central government, and some of it, that is remaining part of it, will be given to state government. right, will be given to state governments. This is important now. This is more than sufficient for economics. Is the logic okay? Central government imposes, collects the taxes, and whatever taxes have been collected, it is called as a divisible pool. I'm using the term divisible pool. Some books will write it as a central divisible pool. And from the central divisible pool, now we will distribute these taxes between the state governments and central government. There is a technical name for this, don't worry. Right? Later we'll discuss. There's a technical name, vertical devolution, horizontal. We'll discuss that later. This is basically the idea of a divisible pool. Now, what is the importance of it? If the central government will impose a surcharge and a cess, if central government will impose a surcharge and a cess, surcharge and cess are not part of divisible pool. Is it okay? I'll repeat it again. The central government imposes and collects a certain surcharges and cesses. These are not part of divisible pool, which simply means how to use the surcharge and cess. It is entirely the power of central government. Right? Either the central government will decide, part of it will go to the state, or a central government will decide, all of it will be kept with me. That is one more very important point regarding the concept of surcharge and cess. Shall I go to the next one here? Right, a surcharge and cess, that is the third point in both, under both of them. Right, it is entirely the prerogative of the center how to utilize the surcharges and cesses, whether they want to distribute with the states or they want to keep it with themselves. It is entirely the prerogative of the central government. Okay, so surcharge, cess, right, these are the points. Let me go to the next one. Anti-dumping, countervailing, and safeguard duties. Anti-dumping, countervailing, and safeguard duties. Now, what is anti-dumping, countervailing, and safeguard duties? Now, nicely I've given three pictures here. Can you see the three pictures? One is yellow, or let's say orange, and I'll call it as yellow only. Second one is orange. Third one is green. Can all of you see the three colors? Let me start with the basic eye test now. Can you all see the three colors? It should be yes, by the way. Which means I'm going to discuss three different situations. I repeat, I'm going to discuss three different situations. Listen to it very, very carefully. Because many of you will start typing questions. You will not listen to what I discuss. You'll simply ask, what is the difference between anti-dumping and countervailing? Despite telling you the difference in the process. Listen to it. Let me start with the first one, anti-dumping. Let me start with the first one, anti-dumping. What is this, right? Anti-dumping duty. Let's start with a very simple example. Imagine, right? Your friend is back now. Imagine you're manufacturing this bottle in India. Okay, you're a manufacturer in India. And I'm a manufacturer sitting in China. I will manufacture this bottle. You are able to manufacture. I am also manufacturing in China. I will manufacture this bottle. When I will export it to rest of the world. I repeat, when I will export it to rest of the world, I will export it at, let's say, 100 rupees. When I will export it to India, I will not export it at 100. I will reduce the price to 97 rupees and export. I will reduce the price to 97 rupees and export. Can I call this as exported at suppressed prices? Let me know. I'll repeat the concept again here. I will export this bottle. I'm from China. I will export this bottle to rest of the world at 100. But when I will send to India, I will reduce the price to 97. This is nothing but exported at suppressed. Suppressed means reduced prices. Now, what is the reason? When I will export it at 97 rupees, you are manufacturing the similar bottle in India at 99 rupees or 100 rupees. Now tell me what will happen to your sales. Think of it. What will happen to your sales? Right? And some of you will and you're saying as expected. Sir, why loss? My dear, how do you assume it is a loss? Tell me, how are you assuming it's a loss for them? What if cost of the production is 80 rupees? What if the cost of the production is 90 rupees? They are reducing the profit margin. But please understand the next point here. Your products will not be purchased in the market. My products, because these are cheaper, people will purchase more and more of my bottles. Will my revenue not increase? Will my profit not increase? Answer is yes. But in the process, what I've done? In the process, what I've done? I have suppressed. Suppressed means artificially reduce the price when I export it to India. I'm not doing it everywhere. I'm doing it only in India. This activity is called as dumping. Is it okay? This activity is called as dumping. Dumping means what? Right? In your homes, your mother, your father will be scolding, your parents will be scolding. You're dumping your clothes there. You're dumping your books here, etc. Dumping means what? Simply, exporting lot of them. Quantity will be very, very high. Right? So basically, in this situation, domestic companies would be affected. The exporter will start getting more and more profit. Can the government of India allow this to continue? Think of it. Can the government of India allow this to continue as it is? No. What government will do is, they will investigate and find that I am exporting this bottle to rest of the world at 100 rupees. But when I'm exporting to India, I'm selling it at 97. So government says, you are dumping. You're dumping the products in India. I will impose a tax which is called as anti-dumping. I will impose a tax on your product now. It is called as anti-dumping tax or anti-dumping duty. Now, when the government will impose an anti-dumping duty against this product that I am sending to India, what will happen to the market price of the product? Market price of the product automatically will start increasing. Now, your products will become competitive. All of you agreed with this idea? Any problem here? Understand the context. Context is very important. Let me go to the next one. Countervailing duties. Okay, countervailing duty. Same example. You are manufacturing this bottle in India. I am manufacturing in China. Now, I want to export this at 100 rupees to India and rest of the world. I'm not actually reducing the prices. I'm not suppressing the prices. I want to export it at 100. But government of China will give me a subsidy of 10 rupee per bottle. Let me check your basics knowledge now. Right, the second class or the third class on GDP. I want to export it at 100. I don't want to suppress the prices. Government of China will give me 10 rupee subsidy. Now tell me, at what price will I export the bottle to India? At what price will I export the bottle to India? 90 rupees? All of you will agree? Any problem with this? I'll export the bottle to India at less than 100 rupees. Same logic. But understand the difference here. Will you call this second example? Will you call the second example as a dumping? Think of it. Will you call the second example as a dumping? Absolutely no. I'm not dumping here. I want to export at 100 to India, to rest of the world, everywhere. But government is giving me subsidy so that I'm able to export the product at 90 rupees to rest of the world. So what I'll do, I will export it at 90 rupees to India. Same. Your products, nobody will purchase. My products demand will increase. Government of India will look into it again. Government of India will look at the situation and tell me, your government is giving subsidy. So what I will do is, when you will export the product and it enters into India, I will impose a tax on it. Is it okay? Right? I will export it to India. Government of India says, I will impose a tax on the product to offset. Can you understand the term offset? I can use the term offset or to negate the subsidy benefit that I am getting. Now let's say, right, I will export it at 90, government of India will impose the taxes on the product. What will happen to market price? Market price will increase. It will become competitive with your product, right? This kind of a subsidy, anti-subsidy, understand the statement here. This kind of anti-subsidy tax is called as countervailing duty. Any difficulty here? This kind of anti-subsidy duty is called as countervailing duty. Shall I go to the next one? So anti-dumping is over, countervailing is over. Third one is safeguard duty. Third one is safeguard. Very interesting. Right? In the third one, please look at the picture. Look at the picture and listen to the example here. I am also manufacturing bottle. China, you are also manufacturing in India. But the technology that I'm using is much more advanced. The cost of the labor cost is already very low for me. Now, because of this, can I simply come to a conclusion? My product will be cheaper compared to your product. I'll repeat the context here. Understand this carefully. I'm manufacturing China, you are manufacturing India. The technology I'm using is much more superior, which means obviously cost of production would be lower. I'm able to get access to raw materials at a cheaper cost. I'm able to get access to labor at lower cost. Now, traditionally looking at it, I am more competitive compared to you. Is it okay? I am more competitive compared to you. So what I'll do? I'll be able to manufacture this bottle at a lower cost, export it to India. My product will be much more cheaper. Demand for this import will be very, very high. Right? Imports will start increasing. Suddenly in India, imports will start increasing. Can the government of India allow this to continue? Think of it. Can the government of India allow this to continue? Absolutely no. But can they impose anti-dumping here? Think of it also. Can the government of India look at sudden imports of these products because they are competitive enough? Can government of India say you're dumping? Absolutely no. They are not dumping. They are selling across the world at the same price, but because they are competitive enough, their raw material is cheaper, their technology is better, their products are much more cheaper. So can you impose anti-dumping? No. Some of you are saying yes. Please understand, you cannot impose anti-dumping. Can you impose countervailing here? Think of that also. Can you impose countervailing? Right? Did I say anywhere did I say in the third one, I'm getting subsidy? Absolutely no. Can you impose countervailing? No. But government will not allow this import to suddenly start increasing and continuously flow into India. If they allow it, domestic manufacturing will never improve. Domestic manufacturing will never pick up. Right? So in order to address this, government will impose one more type of a tax, which is called as a safeguard duty. Right? Safeguard, look at the term itself. Safeguard duties are imposed whenever, because of better competitiveness, imports will suddenly increase into a country. And there's a danger that domestic manufacturing will not be able to compete there. So what government will do is, in order to protect and promote domestic manufacturing, government, whenever my bottle will enter into India, will impose a tax on this that is called as a safeguard duty. Done? Right? So there are three types here: anti-dumping, countervailing, and safeguard duties. Right? So all the three are different. Don't say all the three are one and the same. Absolutely no. All the three are different. So the definitions I've given here. And remember this, some of you are asking me, sir, how will the government come to know? Let's say anti-dumping. How will the government come to know? If I'm dumping the product, you as a manufacturer, forget about the government. You as a manufacturer, will you sit quietly? I hope you understand. Right? I'm dumping the product into your market. You as a manufacturer, will you simply sit quietly and say, right, everything is in God's hands, right? Who can basically do anything here? Absolutely no. You will run to the government authorities. There is an authority under the government. Have a look at this. Directorate General of Trade Remedies, DGTR. Directorate General of Trade Remedies, which will basically take up the case and start investigations. Right? They'll simply start investigations, and if they find that I'm dumping, they will impose anti-dumping duty. If they find that, right, I'm basically getting a lot of subsidies, they will impose countervailing. Right? So that is basically anti-dumping, countervailing, and safeguard duties. Okay, all the three are different. Remember, every month, at least one of them will be discussed in the newspapers. Please keep a watch. You will realize that at least one of them will be there always in the newspapers in the current affairs. Okay, right? So these are the three. Now let me go to the next one. Taxes are divided into two parts here. Taxes are divided into two parts. One is a direct tax. Second one is indirect tax. One is a direct, the second one is indirect. I've given you certain examples here as well as here. Now let's start the discussion on individually one of them or every one of them. First one I want to discuss is income taxes. First one I want to discuss is the idea of a income tax. Now before I start the discussion, please understand, some of you will get confused here. Here is, let's say, an individual. There is an individual. This individual will start, right, working for a company, earn a salary. The individual will start working for a company and earn a salary. On this, government will impose income tax. Any problem with this? Any problem with this? The government will impose income tax. And on the other hand, a company will earn a profit. A company will earn a profit. Okay. Now this is where students get confused. Profits of the company is nothing but income of the company. Is it okay? Profit of the company is nothing but income of the company. So government will impose a tax on this profit, and this is technically called as corporate tax. Is it okay? This is technically referred to as corporate tax. So under the income taxes, please understand, companies are taxed in India. Under income taxes, individuals are taxed. Hindu undivided families are taxed, etc., etc., etc. So first point is, what is the basic idea? From where are we imposing income taxes in India? Income tax, for the imposition of the income tax, Government of India has passed a piece of legislation that is called as Income Tax Act of 1961. Please remember this. Very often this act is quoted in the newspaper. Very, very often. Why? Government wants to introduce a tax on, let's say, right, certain products in the market. Right? Government wants to impose a tax on digital assets. Government wants to impose a tax on, let's say, a new type of a tax base. For all of that, Government of India first will have to amend Income Tax Act of 1961. So Income Tax of 1961 is the piece of legislation. Okay, piece of legislation. It's a piece of law under which the central government is empowered to impose and collect different types, different forms of income taxes in India. Before independence, the law was passed in 1880 and that was used by the government. But over a period of time, government introduced this piece of legislation, right, a statutory piece of legislation, and under this, Government of India has the powers now. And generally we impose and collect individual income taxes, and we also impose and collect corporation tax, that is a corporate taxes in India. Now in case of individual income taxes, two different sets are there. Please do not waste your time. Many of you will try to become a CA, chartered accountant in income taxes. That is, you will try to learn what are the different sets of income taxes which are applicable to individuals. There are two sets, in fact, if you have seen. In one of the sets, up to 2.5 lakh rupees, 0% income tax. 2.5 to 5 lakh, right? It is 10%, but again, it is remitted back. 5 lakh to 10 lakh, it is 20%. About 10 lakh, it is 30%. And there is one more, right? Up to 2, up to 5, up to 7, up to 8, like this. Different two sets of tax slabs are there. Is it needed for UPSC exam? My sincere advice to you is absolutely no. UPS is never going to test you in that particular tax slabs or tax calculation issue. Do not become a chartered accountant and don't waste your time. So income taxes are those taxes which are imposed by the government on the income earned by the individual taxpayer, such as you who is paying an income tax, such as me, right, who is going to pay the income taxes. Now corporate taxes, understand the logic here. Corporate taxes, these are the taxes which are imposed under income tax act only. These are the taxes which are imposed on the profits earned by the companies in India. I repeat, on the profits earned by the companies in India, right? Now, until very, very recently, only one rate of tax was applicable. I repeat, only one rate of tax was applicable, that is 30%. Now, there are different rates which are applicable. Let me explain it to you, but I don't think so UPSC will enter into this. For some of the corporates, they have chosen to pay the corporate taxes at 30% itself. For some of the corporates, they have chosen to pay the taxes at lower tax rate at 22%. And for some of these companies which will start manufacturing by the end of this financial year, it is a 15%. Which will start the manufacturing by the end of this financial year, 15%. Okay, now let's start. Why? What is the reason? This one should be very clear to you. 15% rate should be very clear to you. The government wants more and more companies to be set up and start manufacturing as soon as possible. And that's the reason government says if you start manufacturing by 2024 end, I will give you 15% tax rate. You can pay corporate taxes at 15%. Now, 22% and 30%, what is the difference? If there is a 30% also, if there is a 22% also, why will anybody choose to pay 30%? Understand the logic here. Let me take a very simple parallel example. Imagine your income is 5 lakh rupees. Understand this very carefully. Imagine your income is 5 lakh rupees. Some of you are under the impression that government will impose and collect income taxes on the full 5 lakh rupees. Answer is absolutely no. Is it okay? Answer is absolutely no. What generally happens is, this is called as a total salary. This is called as the total salary. Government does not impose an income tax on the total salary. No. What government tells you is, your income is 5 lakh, first 2.5 lakh rupees. Out of that, first, that is 0 to 2.5 lakh rupees, the tax rate is how much? 0%. Tax rate is absolutely 0%, which means out of 5 lakh, on 2.5 lakh, you don't have to pay any income taxes. How much are you left with now? 2.5 lakh rupees. Done? You are left with 2.5 lakh. Will the government impose and collect the taxes on all of this? Again, no. What if you have invested? What if you have invested in Sukanya Samruddhi Yojana? Have you heard of this? Sukanya Samruddhi Yojana. What if you have invested, right? Let's say under section 80C, that is under PPF, Public Provident Fund. What if you have a housing loan, etc.? So all I'm trying to say is, again, don't by heart all of this. All of this is not needed for UPSC aspirant. It is only needed for a chartered accountant. So argument is simple. Even on this 2.5 lakh, government will not collect taxes from you. If you have invested, let's say in the PPF, 1 lakh rupees. You have invested, let's say in the PPF, 1 lakh rupees. There are various sections under Income Tax Act. Section 80C is there. Section 80D is there. Section 24 is there. 25 is there. There are various sections. Don't worry. So you've invested 1 lakh rupees on Public Provident Fund. So you're left out with how much now? 1.5 lakh rupees. This is called as net taxable income. Net taxable income. Any difficulty? On this 1.5 lakh, now government will impose income tax and collect it from you. This is how the calculation is done. And please understand, once again explain, not required. Leave it. If you have not understood it, leave it. It is not at all needed. Only one point I want you to carry. It is not on the full income that you pay the taxes. It is the taxable income on which you pay the taxes. Which means, right, a certain deductions are allowed. Which means certain deductions are allowed. Any problem here? Right, which means certain deductions are allowed. Now, why this is needed, right? Don't by heart this, not at all required for UPSC. Even if you have not understood anything out of this, leave it. All you need to carry is simply this point and this point. Whatever your income is, only part of, on some of it, after deductions, whatever is left out, deductions are allowed and taxes are imposed. And the same way for a company also. Have a look at this. Just like you, company also has earned profit. Right? Government will also allow certain deductions for the company. Government will also allow certain deductions for the company and later impose corporate tax. Later impose corporate tax. Is the logic okay? Is the logic okay? Now, why should you understand this? Very simple. Government of India says, if you are a company and you want to use deductions, then the corporate tax rate applicable to you will be 30%. Is it okay? I'll repeat it. If you are a company and you want to use certain deductions, then the corporate tax rate applicable to you will be 30%. And you are a company, you do not want to use any deductions, then the corporate tax rate applicable to you will be 22%. Any difficulty in this? Let me know any difficulty in this. Again, don't ask me about calculation. Not needed, right? Not at all required for UPSC. So if a company uses deductions and pays right the taxes to the government, Government of India says, right, the tax rate applicable to you will be 30%. And if a company doesn't use any deductions, then corporate tax rate applicable to them will be 22%. So that is the reason you have 15% also, you have 22% also, and you have 30% as well. Right? So these are some of the important points regarding the concept of corporate taxation. Corporate taxation. Okay, now let me take up the critical evaluation of this, then we'll wind up the discussion for the day. Right? Don't worry about inflation questions, I'll take it up. Please don't worry. Now, what are the benefits? Why has the government reduced, or let's say has given one more option of 22%? Already 30% is there. Why one more option of 22%? Or even why one more option of 15%? Point number one, it will attract a lot of investment. Please tell me whether this point is right, understandable or not. When companies are offered a lower tax rate, 15%, 22%, etc., will it attract more and more investment into India or not? Point one is very clear. And this has been a very, very long standing means a very right a timely demand, or very, very long time the industries have been demanding this. And there is a reason. Tomorrow we'll discuss more on this. At the same point, this was done in 2019 and 2020. In USA, the corporate tax rate was reduced from 35% to 21%. Understand this. In USA, the corporate tax rate was reduced from 35% to 21%. So across the globe, many countries were actually reducing the corporate taxes in order to attract more and more investment. Should Government of India do it or not? Should we also do it or not? Provide certain benefits to our investors, our companies or not? That is the argument. So one, attract investment. Second, we basically follow rest of the world. Point number three, it will promote ease of doing business. It will promote ease of doing business. Now, what is this idea of ease of doing business? Very often you will come across this. Ease of doing business means any policy or the measure undertaken which will help the industries to conduct their activities in India. I'll repeat the statement here. Any policy, any measure that has been undertaken by the government or the government agencies, which will help the industries to conduct their business, conduct their activities in India. Can I give you a very simple example here? Very simple example. Imagine you want to set up a manufacturing facility of the bottle. You want to set up a manufacturing facility. What would you prefer? Example 1, where you will have to take 10 licenses from 10 ministries. Right? What would you prefer? Example 1, you want to take 10 licenses from 10 ministries. Or example 2, where all the 10 licenses are issued by only one authority, department, authority, whatever it is. All of you will agree? Sir, example 2 is a better one, most preferred one. Now, this is basically called as a single window system. This is basically referred to as single window system, single window clearance. Now, can I simply say this example is nothing but one of the measures to promote ease of doing business? Let me know. This is a representation of nothing but ease of doing business. Tomorrow, in fact, we will prove, right? Understand this. We will prove GST also will promote ease of doing business. Reduction in the taxes, will it promote industrial activity or not? Will it make it easier for conducting activities or not? Answer is again yes. It will promote ease of doing business. Next one, the expectation of the government is with the lowering of the taxes, more and more investments will flow, employment will be generated, and that will lead to a virtuous cycle in the economy. Right? So these are some of the benefits that we expected from the corporate tax rate cut. And again, please understand, some of you will simply say, sir, what was the result, etc. In 2019, this was announced. Tell me what happened in the next 2 years. If you want to evaluate such policies, please look at the other situation as well. What happened in the next 2 years? Right? Demand, investment, supply. Don't you think in the next 2 years, all of them went into a toss thanks to pandemic? Right? So these were some of the benefits that were expected. What are the issues or concerns regarding such policies in India? Point number 1. If government will reduce the tax rate, let's say from 30% to 22% or 30% to 15%, what will happen to revenues collected by the government? Simple. What will happen to the tax revenues? Automatically, the tax revenues of the government will come down. Right? It has come down. One of the reasons is this. Again, when I say it has come down, if it was only 30%, only 30%, the corporate taxes collected could have been higher than what they are collecting today. Okay, so tax receipts or revenues have been affected. Point number 2, investments to increase require other reforms as well. For example, I'll take the same one. You want to invest in India and you want to start manufacturing the bottle. Now tell me a very simple question to all of you. Will only the corporate tax rate make you invest in India, or you will also look at other features of India, such as how easily the loans are available in India, how much skilled labor is available in India, whether acquiring land for manufacturing facility, acquiring land is easy or very difficult, etc., etc., etc. Don't you think other reforms are also very, very important? Yes, no doubt. Corporate taxes is one of the very important point. But investors, to invest in a particular economy, they are not only focused on corporate taxes, they are focused on other areas as well, other features as well. And in case of India, these are some of the issues that are holding back the economy. For example, India skilled labor availability is very, very low. We'll discuss this in detail. Please don't worry. I'll take up employment when I'll tell you what is the situation of skilled labor in India. So skilled labor availability, very, very low. Acquiring land is very difficult in India. The best example that I can quote to you people, which easily all of you will relate, is Tata's are trying to acquire land in West Bengal. Did you come across that? Many years ago, right? More than a decade ago. Tata company trying to acquire land for their manufacturing, nano manufacturing land, right, in West Bengal. Or the most important current affairs, bullet train project. Have you heard of this? Bullet train project? Government of India is constructing a bullet train project, right, between two states, that is connecting two states, Maharashtra as well as Gujarat. The bullet train project was supposed to start in 2023. Check this. It was supposed to start in 2023. Now government says not possible. They've pushed it back to 2026. One of the reasons why there has been a delay is acquiring land. Is it okay? Acquiring land. Or else, have you read about Silver Line project? Even if you have not read, nothing wrong with that. Sir, I've not read. Will I fail UPSC? Absolutely no. Last year, the issue of Silver Line was there in state of Kerala. Right? So argument is simple. Acquiring land is very, very difficult in India. Okay? And what about other policies in India? What about some of the other policies of the government? For example, right, I'll give a very simple example. In some of the policies or schemes, government of India says the raw material that the companies will purchase, some part of it, they will have to purchase from the domestic market itself. I hope you understand. The raw material that you purchase to manufacture, you will have to source it. Right? These are called as domestic sourcing norms. In fact, we'll discuss it later also. Right? It is very, very recently, it was there in the newspaper. I'll tell you the connection also. Have you heard of FAME scheme? FAME 2, faster adoption and manufacturing of electric vehicles. Under FAME scheme, you want to get the subsidy from the government. Half of the components, 50% of the components, you will have to purchase it from domestic market. So if you're a manufacturer, you want to invest in India, you look at other policies of the government also. Because if you enter into India, what if you want to import? Government has certain policies restricting import. What if you want to easily hire and fire labor? Government of India has a restrictive policy against it. In such cases, automatically investments would be affected. Despite reducing the corporate taxes, other policies of the government will push away the investments that could flow into India. Okay, right? That is basically the critical evaluation of, right, the benefits or right, the issues that are associated with the policy of the government of India to reduce corporate taxation in India. Done? Right. So these are some of the important points. We'll continue the discussion regarding other concepts tomorrow as well. Before that, let me take up your questions. Let me address your questions. Cess a second point. What is the second point in cess? Some cesses are imposed as a percentage. Okay. Bottle price is 100 rupees. Government will impose a cess of 5 rupees. One form. Bottle price is 100 rupees. Government might impose a cess of, let's say, 10% of value of the bottle. Okay, done. Any other questions? You will check about the transfer payment in Nitin Singhania. I answered that question on the same day. On the same day, I answered the question. I don't know whether you listened to my lecture or not. Right? Basically, I told you transfer payments, the Nitin Singhania book says a government employee getting a pension is not counted as a part of transfer payment. In fact, I told you in India, we provide pensions to elderly people. Pensions to elderly people. Some of the right schemes are there. Please check it. I told that such kind of pensions to elderly people, without, it's a scheme, it's a subsidy. Those are counted as a part of transfer payments. If anyone invested in their whole amount in PPF, then tax, my dear, if you have invested everything, the PPF limit, maximum threshold limit is 1.5 lakh rupees. Why these are called as duties and not taxes? My dear, tax is a very generic term. Tax is a very generic term. It basically changes from one system to another system. For example, if you talk about imports and exports, we generally don't use the term taxes there. We use the term tariffs. So one context to another context, the term that is used slightly changes. Why only HUF, not Muslim, undivided family or any other religion? Right? I don't know what is the context of the question. Okay. What if not? Okay, what does this? Last slide, fourth point, benefits. It will expect that private sector will invest, then basically it will lead to virtuous cycle. My dear, if you don't understand virtuous cycle means you are not revising. I can only tell you this. You are not revising then. We have discussed what is the importance of savings, investment, and that will lead to virtuous cycle. That is basically the argument here. And understand, it was in 2019 and 2020. Automatically, right, it will promote recovery in the economy. Ad valorem tax on the value of the product. Value of the product when the tax is imposed. Again, what is value? Price of the bottle, let's say 100 rupee. That is value. Okay. Can state governments imply cess within the state? Of course, yes. Examples are there. Right. Best example for that is Kerala government. They have imposed a type of cess. Okay. Okay. Fame too. Please read. Right. Everything I can't read. Please read. Your duty is to read newspapers. If you don't read newspapers, I don't understand how do you expect to become updated with current affairs. Everything you cannot be reliant on me only. You also read something. Regressive taxes, regressive taxes. I'll repeat it again. Again, don't get into technicalities. Don't enter into average rate, marginal rate. That is not required. Simply understand as the tax base increases, the taxes will come down. Such type of taxation is called as regressive taxation. Inflation discussion will have a tomorrow. Questions on inflation will solve it tomorrow. Have patience. Are we paying cess? Of course, yes. Many of the income tax payers are saying paying cess. Healthcare and education cess. Okay, done. We'll stop the discussion today here. We'll continue the discussion from this slide. Again, we'll discuss the questions on inflation tomorrow. We'll start the discussion from this slide, that is capital gains tax, tomorrow. Okay, take care. See you tomorrow sharp at 5 p.m. Bye. Good night.